Hello everyone, good afternoon and a warm welcome to this one of its kind unique conference, the International Webinar on Contemporary Issues in Accounting and WRC of ICAI along with the Indian Accounting Association. I'm sure it's raining heavily outside and all of you must be enjoying the weather here. But yes, we are here to discuss something very important and significant, that is the future of this accounting profession. And two very able bodies are here today to talk about these. Before we can start, may I now request all of you to please put your hands on your heart for as we play the ICI motto song.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Thank you everyone. Uh, Once again, a very warm welcome. Today, I am joined on this wonderful event. I'm joined by the chairman of WIRC, the Western India Regional Council of the Institute of Chartered Accountants of India, CA Manish Garia. We have our Central Council member, CA Rajendra Kumarji. We welcome you, sir. We also have past chairperson of the Western India Regional Council, CA Preeti Savla. The Vice Chairperson of the Western India Regional Council, CA Drushti Desai Madam, who has joined us. Along with me, I have two colleagues, CA Murtuza Kachwala and CA Kamlesh Sabu, Regional Council member. Faculty for today, CA Divya Abhishek. And the one different thing that you will see today is a new body, that is the IAA, Indian Accounting Association. And we've got office bearers of that, Professor Sanjay Ji, the General Secretary of IAA. We welcome you, sir, on this. Friends, we are all at a very important time in terms of we have to decide, because of a recent event. We have been pushed 5 years ahead of time in terms of doing everything online, in terms of learning everything online, in terms of understanding skill sets which are totally different that we were supposed to do if we were in normal times. Digital has made lives far more simpler, but also complex. And today, as we are all at the cusp of this revolution, when we are ready to adapt the digital learning, digital way of working as an accountant, as a catalyst to ensure all the businesses have become robust to adapt and survive in this changing scenario. I think this seminar, therefore, has a lot of importance, because when a body which is instrumental of educating, of giving out members from a learning perspective of accountants, the IAA, and the WIRC, which is a body of representing chartered accountants, who are the accountants for most of the entities. These both combined together can really shape the future, who are expected to control, who are expected to revolve, who are expected to bring a revolution for all the businesses overall across the country. We are looking at absolutely digital economy. We are absolutely looking at digital technology. We are absolutely looking at something which we were never even thinking about. So we have to adapt to these kind of technology. The entire modus operandi, the entire change, the entire way we work has changed overnight. So I think, therefore, this event is the first stepping stone to talk in this direction. To tell you more about this, may I invite Sanjay Bhayani ji, the General Secretary IAA, to set up the platform and share his insights about this event today. Over to you, Sanjay ji.
Good evening to everybody. Uh, respected President of IAA, Professor G. Soral, respected Chairman WIRC, CA Mani, CA Dhruti Desai, Secretary WIRC, CA Arpit Kabra, and all entire team of ICAI and entire team of Indian Accounting Association. I am very happy in India presently new education policy, National Education Policy 2020 that has been adopted, and I can say this is a first stepping stone where professional and they had tried to organize a one international webinar, and this is a need of a day. And this is as per the remarks of the CA Manish Gadia ji, this is a beginning. So we hope that journey will be continue and it will be survive for a longer period in the interest of India to implement national education policy. So earlier it was a gap between the academia and practitioner. So this is a first beginning. So I'm very happy. And today we have decided a wonderful topic, that is contemporary issues in accounting. This webinar is divided into 2 days, 5 to 8. Today there will be 2 sessions from the practitioners. Tomorrow there are the 2 sessions from academicians. So the topic selected for this joint webinar being held under the joint auspices of Western India Regional Council of ICAI and Indian Accounting Association are contemporary relevance. First is accounting standard for non-corporate entities like sole traders, HUF firms, partnership firms, LLPs, cooperatives, NGOs, etc. Whereas the traders, MSME and farming sectors and agro processing and service providers fall under this category. It may account for a major chunk of our GDP. Accounting practices are very diverse and weak for or full of loopholes. But standards which we propose must be easy to understand by them and also affordable for them. We have to be pragmatic in our approach while providing this solution. Where the second topic is related to the input credit under the goods and service. Reforms making in India is a big common market. It has to be ensured that liability for ITC is discharged by the government on time. Delay credits a lot of financial problems for the claimant. The grave risk factor is non-payment of GST or failure to file return on time by firm in the tax chain. This leads to frustrations or denial of ITC by the government. The claimant is punished for no fault of his own or even which is beyond his control. So careful thought may be given to this serious issue, and we should offer some pragmatic solution to the business and government both. The third topic is related to the what is better financial reporting. An eminent professor of accounting from USA, Dr. and Professor Shyam Sundar, will answering this query conveniently for all the stakeholders. He may also reveal the reason for his choice of the word better in lieu of the best in the topic. Whereas the last topic that is related to the cultural impact on accounting, although it is of a vital contemporary importance, get most neglected on accounting research and studies. We should not be surprised to know that accounting theory is positive. It is not affected by cultural factors, but accounting practice or malpractices has its roots in culture of each geography. It has a relationship with the other topic of this webinar. For example, we have a Ind AS and not IFRS. And USA has its own GAAP, not IFRS. Why no uniform accounting standards are adopted globally in in spite of a lot of benefits claimed in the globalization. So you can find answer in desire to have a own culture identity. In the same way, a lot of problems created in ITC of GST are rooted in culture of tax evasion. Let us think why non-corporate sector has a good accounting system. We may again trace these roots in cultural factors. So I am sure this webinar will be great steps towards in satisfying your thirst for knowledge and also to create thirst and curiosity to learn more on this topic of great academic and professional relevance in the contemporary world. So all the four topic is highly relevant in the present environment, and we all are sure that we give a very in the present field of accounting. So thank you very much for this wonderful event. Thank you.
Thank you, Professor. And rightly mentioned, the national education policy, the new policy, is a setting benchmark. And as you mentioned, there are these different Ind AS, accounting principles, all of this. I think all of us together can really ensure that we adopt and we move towards best practices in accounting and recognition as well. That will help all the stakeholders come on a single same page. Great. Moving on next, we've got a Vice Chairperson, West India Regional Council, C. Drishti Desai with us. I would request Drishti Madam to please briefly address the gathering.
Thank you, Arpit. First of all, my heartiest congratulations and a very good evening to all the dignitaries present here on the dais. In interest of time, I would not, take everybody's name, but my heartiest congratulations. And first of all, I would say that at Institute of Chartered Accountants, our endeavor is always to, improve the reporting. We are looked up by the government as the body that draws up or kind of recommends what is the right accounting standard to be followed, so that there is good transparency, understanding, and of course the taxability and everything comes hand in hand along with that. So we are playing that important role here of even formulating standards, and then we are the ones who will recommend to the government, and then they are notified. So we are very, very pragmatic in drawing up these standards, and I really appreciate what Professor Bhayani said about having more consistent standards across the globe. So in case of India, barring a few changes, everything is almost aligned with IFRS, so that we are more in line with international standards, so that we are international accountants. What we give out to the society are international accountants, and that is our endeavor, so that there is greater opportunity for employment also to our members. And this is a great association that I would say here with IAA, which is a body of all academicians in accounting profession, and with the institute, which is here to help the government and formulate the standards. So I think this is a great thing, and this is the first time that such a program has been put up. So I congratulate the chairman for this wonderful session that has been put up. And over to you now, Arpit, for taking it forward. And thank you very much for inviting me here.
Thank you, madam. Rightly mentioned, the joint efforts by the chairman WIRC and the president IAA, Soral sir, I think it's a unique blend. And with academicians along with professionals coming together, I'm sure this will make a huge difference. To know more about this difference, let me invite the chairman, C. Manish Gadia of WIRC, to please address and share his vision about this entire setup. Over to you, Manish Bhai.
Thank you, Arpit. First of all, I thank Professor G. Soral, President IAA, for agreeing to have a joint program. So as we are discussing, this is a blend of academician as well as the practitioner. And if this two fraternity comes together, then we can do wonders. And that's what we have started, and I should say this is just a beginning. This is the first program and we are getting an overwhelming response. So this is an international webinar on contemporary issues in accounting, where we do not have only faculty from India, but faculty from USA, faculty from Oman, apart from India. And we have our Central Council members here, Rajendra Kumar sir also, who is a topmost person as far as the GST concerned in India. And other faculty, Divya, Abhishek is also here. Both the faculties today are from Chennai, I should say. So we have across globe faculty for this. So I'm really thankful to IAA for joining hands together. I will tell about only one initiative what WIRC has took, and I need the support for this from all the teaching faculty across India. So WIRC has started a project called TEL, that is Train, Earn and Learn. And as I said, academician as well as the practitioner is the best blend available today. So in this project, we are blending these two things where we are taking a session for undergraduate students who are not pursuing CA course. For them, we have structured a 36-hour of training program, which is a brainchild of our secretary, Arpit Kabra. In that, we are teaching them filing of income tax return, GST return, entry in a tally, Excel, like this kind of courses we will teach them. After going through this course, they will be ready to take some practical experience with a CA firm. And there they will get a training of at least 1 year, which will enhance their skill, and which is the motto of the government also, to have a skill set, enhance the skill of the student. So it will be a win-win situation for even the college, because as per UGC norms, college is also required, because I discussed this course before launching with G. Sural sir and took his views. He said this is the best course available for as far as the UGC guideline also, and he is also ready to promote this course across India in various colleges. So I think G. Soral sir will be most apt person to tell about this course when he is going to speak. So I am saying this is win-win situation for colleges as well as student also. Apart from academician, if academics and theory, if they will have some practical knowledge, the value in the market will be high for the student. So I request all of you, all the participants, to promote this project to make a life of student better. As far as this webinar is concerned, Professor Sanjay Bhyani sir has already explained in detail about all the topics, so I'm not going into that detailing. So thank you very much. Over to you, Arpit.
Thank you, Manish bhai, and rightly so. These are some of the steps that we are taking towards making sure that we get world-class accountants. And nothing best than if they get trained with professionals like us. So amazing initiative that has been taken. Also, friends, let me tell you, we are all geared up for having the first of its kind, the first ever World Congress of Accountants right here in India. ICAI will be hosting that program in Mumbai. So I think that will be a marquee event that will set up India on the footprints, international footprints of this entire accounting body. And I'm sure with small little steps like these, when we two bodies come together and we tie up and we move ahead, I think we can make this Congress a huge success, which is going to be held on 18 to 21st November 22 right here in Mumbai at BKC. So all that said, now moving on, let me invite G. Soral sir. I think the president of Indian Accounting Association, who doesn't need introduction, but I would like to just tell you quickly. Uh, the professor and head department of accountancy and statistics, University of College Management Studies, Dean Postgraduate Studies, ML Sukhadia University, professor and head department of commerce, Mizoram University, Aizawl, 39 years of experience as university faculty, 27 PhDs, 2 postdoctoral, 10 MPhil supervised, 3 books, 50 research papers, alumni of IIM Ahmedabad, member of American Accounting Association, and it goes on and on. A corporate trainer, a fantastic academician. Let's put your hands, as Kamlesh Bhai mentioned, indicates, to welcome G. Soral sir, who has really put this entire thing in a proper framework. May I request him to please address the gathering?
Thank you, Arpitji. I'm sorry, my video is creating some problem, but I think I am laudable. Okay.
Absolutely, sir.
Yeah, dear friends, in this international webinar on contemporary issues in accounting, being organized by the WIRC of ICAI and Indian Accounting Association, all my friends, beginning with the chairman of WIRC of ICAI, C. Manish Gatia ji, my friend and General Secretary of Indian Accounting Association, Professor Sanjay Bhayani ji, Drishti Desai ji, Arpit ji, all Divya, Abhishek ji, Rajendra Kumar ji, as I mentioned, he is the council member, and past presidents of Indian Accounting Association, council members of both the bodies, learned participants. And I would like to mention here that yesterday I was going through the list of participants. Many young students have also enrolled for this. So it's a wide spectrum, of maturity wise and seniority wise that is joining here. We had more than 1,200 registrations for this. And at the very outset, I would like to thank and congratulate CA Manish Gadia ji for this initiative. Actually, it is he that he took an initiative and talking to me and asking, can we have a collaborative function like this? And you see, for us, we being in the academy, I mean, it's a day-to-day job. We used to discuss, have webinars, etc. But for you people who are senior chartered accountants, busy with your profession quite a lot, thinking in terms of academics, for that definitely accolades to Manish ji about it. And for that matter, entire WIRC of ICAI. The TEL initiative, in the program also I was invited by all of you. I was party to that. That day we discussed a lot. Manish ji was mentioning about it just before. It's a great initiative from the ICA side. And that day when we discussed it, I started talking about it, but somehow some communication gaps are there. About that I will talk to the office bearers of WIRC later on. That I made some communication that in Rajasthan, if we offer some colleges to join this program, because Rajasthan is out of WIRC, then how the colleges will be recognized and all. Of course, those issues we will touch upon later on. This is not the right time for discussing it. But these initiatives from WIRC of ICAI under the able leadership of Manish ji tells us that you people are moving in a right direction. You being professionals, as Arpit ji was mentioning in the beginning, it is very essential that the two bodies join hands. In fact, dear friends, this is happening all over the globe. In all those countries where you find accounting at a high mast, this is exactly what's happening. And you see, just to talk about a little background of the subject which is dear to our hearts, both CAs and the professors, the accounting. If you look back 10, 15 years, of course, I have already been introduced to have been teaching for 40 years. If I really compare my earlier years of teaching with the later years of teaching, there is a sea difference. But many of you are younger chartered accountants, and you yourself must have noticed that our subject accounting is now in heavy demand in terms of quality and performance. Not that we need now large number of accountants. In any case, we need. But demand on our subjects has increased like anything. And the complexity of transactions, the variety of transactions, particularly over last 2 decades, I would say, has phenomenally increased. If you compare the financial statements details of some 25 years before period or even 30 years before period and the current accounting statements that we have because of all these regulations in terms of Ind AS, etc., there is a major change into it. We who are in the academy and preparing the young generation for entering into the profession, we know that as all of you, the chartered accountant friends, may be knowing, there is a corporate accounting subject in undergraduation, commerce. And those teachers who have been teaching it, now they are under great pressure because corporate accounting has totally transformed. And that's very, very important. Now, IFRS and Ind AS have come. We in the academy have also started teaching them. I used to be in the Mohanlal Sukhade University. I recently retired from there. There we perhaps were among a pioneering university in the entire country who introduced as many as 4 full courses on teaching Ind AS. 4 full courses. You can very well appreciate what detail we might have been giving. Arpit perhaps was mentioning about ICT impact. Yes, perhaps he was mentioning about it. You see, ICT is in fact wedded with accounting now. You can't separate them. But it's a great opportunity, at the same time a great threat also. You would definitely appreciate it, those who are in practice. And this is giving us a great challenge. Giving us means the academicians and the professionals. Now, therefore, as I used to say, that we jointly, the 2 bodies, Indian Accounting Association, Chartered Accountant Institute of India, we are primarily responsible, so far as the country responsibility on us is concerned, to take the level of accounting in our country to high mast in the world. You very well know, and we also know as teachers, you see, you all have passed through the academy in any case. We are proud of the fleet of chartered accountants that we have. All our bright students are CAs. And as a whole in the world, among professional accountants, there is a special place of Indian chartered accountants. Many of my students used to tell me, I used to tell them, you are very bright, why don't you go to US also, take their degree of CPA and all. They say, sir, that is easy. I mean, once I have qualified my CPA, I may manage. I mean, this is general word. I have not examined it exactly. And I don't mean to say that in any case, CPA is a lighter degree or anything. But the only point I'm trying to make is that Indian Chartered Accountant is not only a very reputed degree, a reputed profession in India, but all over the world. And about that, we the teachers feel very great proud about. But friends, this will not only help us. A time has come when lot of research in accounting, high quality, pragmatic, future oriented research has to take great place in India, where both of us shall have to join hands. I was mentioning in some audience some 15-20 days before, and there I used this phrase. I said, 1 mother accounting, 2 children, the professors and the practitioners. The 2 children have to take care of the mother. We have to join hands, because you see, we as professors, basically, you see, it's part of our duty to do research, to promote research, to guide research. We all have been doing it. You all know that. But at this, so far as our subject of accounting, auditing, and taxation in particular is concerned, it's all applied. And if we sit back only in the academy and don't look at what is happening in the practice, perhaps the researches may not be pragmatic. Same is the situation with the chartered accountant friends. They otherwise also are busy in their profession and may have comparatively less time to devote to academy. But they have first-hand experience about practices. So that way, it's a win-win situation for both the professional friends, the professors, and the practitioners, that we join hands and develop our subject. In one webinar, because all these Corona period, I have been joining several webinars of the Institute of Chartered Accountants of India. I've been invited, and many times we had collaborative functions, Delhi and other places. I am thankful to all of them for giving this recognition to Indian Accounting Association. And it was mentioned, the council member is sitting here, and Divya ji is perhaps herself a member of the Accounting Standard Board. So I may not be very correct in my memory, but they mentioned that last year some senior person was mentioning it, that Institute of Chartered Accountants of India is a honorable member of the International Accounting Standard Board. They are signatory to that. But generally, what's happening, we all know. You see, the IASB is a entirely research devoted body to accounting standards, and they are doing marathon task in developing the international accounting financial reporting standards. But I was told that CA Institute, our CA Institute, ICAI, also took initiative, and perhaps on forensic accounting, if I am not wrong, they took an initiative on their own and sent a draft to the IASB for their consideration. I mean, that once was told, I often quote it in my speeches, that see, our chartered accountant fraternity is now coming up to show their face at number one, in the front row in the world, because they say that we are not only practicing the accounting which others have dictated and we have become party to it, but we have started researching, we have started developing newer tools of accounting now. So that's a great initiative. And then again, as I've said earlier also in your 14th May function, that the past president, of ICAI, who took initiative and which is continuing now, the International Research Awards. See, the Institute of Chartered Accountants of India, along with their corporate reporting awards, which have been a very old practice with them, very glittering practice, okay, they started this year in 2020 offering international research awards to academicians also. In fact, I have also been fortunate to bag 2 awards into it, but that's not the point. Point is that, see, the intention of the institute is going in the right direction. And I attended that function, that the way we academicians were treated by the institute there, I just can't say it was overwhelming. Now, this is the right direction in which we are moving. And therefore, friends, I would call upon the CA fraternity in particular, who are listening to me, and in especially Manish ji and his team, the senior chartered accountants who are present here, let us think more in this direction. In fact, one more initiative from the ICA side is that you have already offered the research projects. Last time also it was mentioned here, 10 lakh rupees around some institute has offered, and many of us have applied for the research projects there, and that screening is going on at the moment. Very soon they may perhaps declare. I have also been party to that process little, therefore I know about it. So that way, one after the other, we find that the institute and the professionals in the CA fraternity are moving to recognize academics' importance, giving time, money, effort, recognition to academics. But it has to go on. It has to go on. And I would call upon particularly the WIRC, they being the biggest regional council of CA Institute in the country, to think in this direction also. Let us join hands and do more researches, which will be to the benefit of all of us. So I've taken enough time, and I congratulate all the participants who are sitting here to listen to the four great speakers here. Tomorrow, Professor Shyam Sundarji will come, Dr. Kanis Fatima will come, the academicians today, 2 stalwart chartered accountants are there. We will have great pleasure in listening to them. And I finally would only say that let this relationship between the WIRC and the IAA go long. Thank you very much.
Thank you so much, sir. In the entire events and in the entire chain of thank you, I would be failing in my duty if I don't recognize the efforts of one of our very senior employee of ICAI, the backbone, Kapoor madam, who has been toiling day and night hard to ensure that this entire framework gets fructified, and it's in front of you. So thank you, Kapoor madam, and thank you everyone from IAA for setting this up. Moving on, next we got an absolute charming faculty amongst us, Divya Abhishek ji. I would now request our dynamic regional council member Kamlesh Sabu ji to please introduce the wonderful Divya Abhishek ji, so that we can start off with the first technical session. Over to you, Kamlesh bhai.
Thank you so much, Arpit, and thanks to Manish bhai, Chairman of WIRC, and Secretary Arpit Kabra, WIRC, and other dignitaries, along with today's speaker, CA Divya Abhishek. And I'm really privileged to having her biodata and reading her profile in front of all of you. She is BCom, FCA, ACS, CMA, LLB, and ADIT from UK, and diploma in IFRS. CA Divya Abhishek is a practicing chartered accountant at Chennai. She is a Bachelor of Commerce from Madras University and fellow member of the Institute of Chartered Accountants of India and associate member of the ICSI. She has secured 46th rank in CA, 23rd rank in CS, and she is a law graduate, having passed her LLB examination with the flying colors. And she has secured 4th rank in the International Taxation Examination, that is ADIT, conducted by the CIOT UK. And she is qualified in the proficiency test for independent directors conducted by the Indian Institute of Corporate Affairs. Divya Abhishek has completed her diploma in IFRS with Association of Chartered Accountants London and advanced diploma in international taxation with the Chartered Institute of Taxation UK, and has obtained her certification in international tax law and transfer pricing from Leiden University, Netherlands International Tech Center. Under the guidance of the world-renowned Professor Kees van Raad, she has also attended special session at Harvard University. CA Divya Abhishek is the youngest professional to reach this milestone. She did her articleship training with the ENY in the Audit of Assurance Division, and after qualifying as a chartered accountant, she continued to work with EY in Audit and Assurance Division. Divya has audited and consulted for listed companies, corporate multinationals, public companies, private companies, and other forms of organizations, including high net worth individuals. She was also selected a team constituted by the Ernst & Young as a special task force to deal with the impact of the Companies Act, which also involved presentation and discussion at various MNCs. Divya is a prolific speaker and she has addressed over 800 conferences, seminars, and workshops organized by the corporate forums, professional bodies, Chamber of Commerce, universities, and colleges. She has co-authored a book on income tax ready referencer, which is well accepted in the professional and academic circles. Positions held in the Southern India Regional Council of the Institute of Chartered Accountants of India, that is SIRC of ICAI. Divya Abhishek has been nominated in the following committees constituted by the SIRC of ICAI: in Corporate Law and Corporate Governance Committee from 2015-16, 16-17, 19-20, and 21-22. She is a member of International Taxation Committee also in that SIRC of ICAI. Apart from these all academic, she is having very good hobbies, and she is a member of Madras Gymkhana Club, that is, and Madras Cricket Club, Presidency Club, Cosmopolitan Club, Golf Club, Mylapore Club, and Madras Race Club and SBC Club. She is represented in district tournament for badminton, and she is an avid table tennis player too. She is a overseas leader and established a book club for women at Chennai. So many.
I think,
yeah, I think she has done everything. Nothing has been left by her. At this age, I thought initially she must be an article clerk, but now she is a chartered accountant in FCA. I do welcome on behalf of the WIC to CA Divya Abhishek. That is all yours, madam. We do welcome on behalf of the entire WIC.
I think perfect blend of professional and academician in front of us. Thank you, Kamlesh bhai, for that wonderful introduction. Divya, madam, over to you. Please take it.
Thank you so much, Kamlesh sir, for such a humbling introduction. A very good evening to one and all. I thank Chairman CA Manish Kadia for this wonderful conference that is organized, and Professor Sarolji for gracing the occasion. I also recognize the presence of CA Rajendra Prasad, Chairman of Central Council, Arpitji, Sanjay Dayaniji. Very, very good evening to one and all present here. Sir, could you give me access to share my screen, please, sir?
Right on your screen. Michelle?
Yes, sir. So, okay, can you see my screen, sir?
Yes. Slideshow mode?
Yes, sir. It is in slideshow mode.
Yes.
Yeah. So, very good evening. The topic for today, accounting standards for non-company entities. Generally, when we see accounting standards, we automatically assume it is something for large companies, for corporation. We do not have to worry whether as a chartered accountant or on the other side as a management who's taking care of the accounts of a company or a non-company entity, that it is not applicable for a sole proprietor, smaller firms. As long as we file our tax return, our job is over. But friends, I want to remind all of you today, by very virtue of you being a chartered accountant or you filing the return either by yourself or through a chartered accountant, you are bound by certain guidelines, wherein whether you are filing Mukesh Ambani's company returns or the roadside tea vendors returns, you need to follow principles of accounting standards. Therefore, you might immediately ask me a question. How is it new? Accounting standard has been there for many years. What has changed today? Why is this topic contemporary in nature? The reason is bifold. The first being, by very virtue on 31st March 2021, ICAI has released certain notifications and guidelines which clearly demarcates and tells us what all entities need to follow accounting standard and what you need to do in that regard. Secondly, there is an authority set up by the ICAI which reviews the financial statements or the returns filed by the auditors. So far, this quality review board focused mostly on larger accounts because it was felt the impact to the stakeholder is far higher and hence they need to focus on that. However, today it is picked at random, thereby including the T side that vendors' returns might be picked up at a future date by a regulatory authority to verify if the accounting standards are being followed. Hence, it is imperative that we as professionals, as accounting bodies, understand what this notification holds and what our responsibility is in disseminating the information and knowledge to fellow professionals. The numbers speak for itself, friends. What you see on the screen is the latest Jan 2021 income tax released a notification where it said how many companies or non-company entities filed under Form 3CA and how many others filed under Form 3CB. Now, Form 3CA is applicable for any entity wherein there is a statutory requirement to conduct an audit, which means all your companies, because statutory audit for companies is mandatory. LLP where turnover is more than 40 lakhs, audit is mandatory. Form 3CB is for all the other entities where there is no statute which requires audit, but they're anyway filing your tax audit report due to the turnover criteria. When you see the numbers, friends, 2.8 lakhs is for Form 3CA, Form 3CB is 25 lakhs, almost 5 times. And this is only for entities which have tax audit. When you take entities which do not have tax audit, your non-company entities will at least be 30 to 40 times the number we see today, which is why it is extremely critical for us to learn what is applicable to a non-company. It is no longer enough if we are aware of the Ind AS and accounting standards applicable for companies, but also keep in mind for a non-company entity. Now, what comes under this bracket of non-company entity? As you can see on the screen, you have your sole proprietor, partnership, HUF, AOP, society, so on and so forth. Now, when you practically see the screen, we automatically assume when you read sole proprietor or a partner that it is going to be a smaller entity, the magnitude might be lesser. Now, again, friends, let me highlight the fact Airport Authority of India, the global hub for multiple airports across the world, more than 50,000 crores, is a non-company entity. It is not registered under the Companies Act, but it is guided by the statute of the Airport Authority of India Act. Thereby, it is not that when you see the word non-company, automatically it is a smaller entity. Multiple entities, be it your LIC, Airport Authority of India, they are not coming under company, but they will be coming into this non-company bracket. Therefore, it is interesting to note the same report that one might be preparing and understanding for that roadside tea vendor, same report your Airport Authority of India is also following to understand the repercussions of this. Now, one aspect which I didn't cover in the previous slide is a limited liability company. Whether a limited liability partnership comes under a company or a non-company entity. That is where, friends, we have to appreciate the notification that is released by the Institute on 31st March 2021, where they clearly made a very significant change. All this while, the entities that we are speaking about were called non-corporate. Now they changed that word to non-company, and this is why the change has come. Section 3 of the Limited Liability Partnership Act clearly determines a limited liability partnership to be a body corporate. Thereby, earlier, when they said non-corporate entity, your LLP did not fall in that bucket and all LLPs automatically had to follow all accounting standards. But today, because of this change of word from non-corporate to non-company, automatically we can determine any entity which is not registered under Companies Act 2013 will fall into the bucket of what we are going to discuss today in terms of the accounting standards applicability. Now, having understood what forms as a non-company entity, let us understand the second aspect. Why is this relevant to us? Where does it say that a non-company entity is required to follow accounting standards? Because nobody is issuing any report separately. Like when we have a company, mandatorily under SA 700, the auditor has to issue an audit report. Now, where are we doing that in this regard? Let us take the first scenario where you have a non-company entity wherein tax audit is mandatory. Generally, when an entity has turnover of more than 10 crores, if cash transactions are less than 5%, or more than 1 crore, if there are cash transactions, mandatorily that entity has to issue something called as a tax audit that needs to be done under Form 3CD. Very clearly, the institute has mandated and said under section 44AB in their guidance note, where they've clearly said whenever you do a tax audit as per section 44AB, it is mandatory for you to follow accounting standards. So no questions asked for whichever entities that cross that criteria of turnover, automatically you as auditors, they have to issue something called as a form 3CA or 3CB that I told you at the start, which very clearly has specific clauses, clause 3 and 5, where you have to say whether the records are true and correct. And when an auditor says something to be true and correct, it is imputed that accounting standards are required to be followed. Now let us take the second scenario, which most of the non-company entities will fall into this, which is going to be, he is going to be a non-tax audit assessees. Now, a very common aspect for this, especially when you have retailers, shop vendors, they do not start as a company. They typically start as partnership firms, HUFs, wherein tax audit might not be applicable to them. Now, in that scenario, the event where they have lesser turnover, whether do they still need to worry about accounting standards? Again, the answer is yes. There might be a situation where they might want to go for a loan to the bank. So they will go and submit the balance sheet, which is signed by the auditor to the banker, because we are all aware today, you will get a loan only if you provide the balance sheet of your company. Automatically, whenever an auditor does any attest function, as per the preface to the statement of accounting standards, it is mandatory that he follows accounting standards. Secondly, we are all aware that RBI from time to time regulates certain requirements, which has clearly told bankers in the event where any person has more than 10 lakh as working capital borrowing to run his business, ask them for a signed balance sheet. Thereby, even those entities are required to follow accounting standards, because the auditor needs to sign on the balance sheet. He is going to insist on you to follow these accounting standards. The last scenario, there is no attestation function, nothing is done, the person is not going to go for a loan. Does he still need to worry about it? The answer, unfortunately, is yes. He still needs to worry about the accounting standards, because it clearly says whenever a person has obtained the membership with the ICAI, automatically he is required by his code of conduct and ethics bestowed on him by the institute in the various clauses that you see on the screen to do any work in compliance with the accounting standards only. Thereby, because your auditor or your chartered accountant who is going to file your return of income itself, he is bound by his ethics for you to disclose everything as per accounting standards, thereby also imputing that you as an accountant need to follow the same. Where does it say? Even in your SA 320, the standards of auditing very clearly says material misstatements as per SA 320 includes non-compliance with accounting standard. So you will be violating various provisions by not following the accounting standards. What are the repercussions? Now, all this while, for non-company entity, not much time was spent in understanding these compliances. Today, what is the repercussion after this notification came out? One, as I already said, the review board constituted by the ICAI picking accounts in random. So the event where any account that you have done or a chartered accountant file is picked up, then there can be disciplinary actions against both the company and the auditor, and penalty up to 5 lakhs, or even removing the member from the Institute of Chartered Accountants of India. So this is the significance that happens when an entity does not follow accounting standards. A very practical question that comes up when I finish this is, does this mean whatever balance sheet we've been preparing, it is not as per Companies Act? For smaller entities, we merely did what we see on the screen, a horizontal form. Is it not in compliance? That's where we need to always demarcate what Companies Act 2013 says and what otherwise. As long as you follow substance over form, wherein you are still complying with accounting standards, the manner of presentation does not have to be in alignment with your Companies Act 2013. Having understood the two aspects, friends, what comes under your non-company entities, what comes, why you need to do it. Let us understand the third aspect. Are all standards applicable? Now we are aware when you have a company, automatically it comes with the wherewithal. There is the bandwidth to have a separate team to do that. But when it comes to a non-company entity, it is not necessary that it is going to be a large team. Now, do they also need to get all these aspects? What is the impact? What are the standards that are applicable? That is where it's very appreciable on the effort that ICAI has taken in terms of very clearly telling us which entities they've split this whole non-company entities into 4 different levels based on their turnover and volume, and they've clearly said which entities accounting standards are applicable, what accounting standards are applicable, and what exemptions are provided in this regard. The highest standard setter body for accounting standard is only the ICAI, which has the power to formulate. In fact, these changes have come almost 17 years after the last time the changes have come. Very, very significant in the manner in which accounting is going to be done today onwards for these non-company entities. So I'm going to take some time to cover what are these standards, what exemptions ICAI is providing, and some practical aspects of these exemptions when we do a non-company entity accounting or the audit. As I already said, the applicability for the provisions we discussed is already in place. It is with effect from April 1st, 2020, which means for your year closing March 31st, 2021, you need to take into account all these new accounting standards that have become exempt or applicable. I also want to clarify, there are no changes in the accounting standards. Whatever 29 accounting standards are there, they remain the same. What has changed is the applicability, exemption, and disclosure exemptions provided. This discussion, it is not going to be applicable for a non-company, which is a subsidiary, associate, or a joint venture of a company which is required to follow Ind AS accounting, because automatically those entities have to also follow Ind AS. So there is no requirement for an accounting standard exemption. So having understood the ICAI notification and the ideology behind that, friends, what ICAI has done, it has split your non-company entity into 4 levels, which is going to be large, medium, small, and micro. Before this, there were only 3 levels. For the first time, they've introduced a residuary clause also. Very beautiful way in which this amendment has been made. It is made in line with your MSME that the government proclaimed in June 2020. In same line, they made these changes. So what is a large entity? Any entity which has securities which are listed or in the process of listing. A very logical question comes, already it is not a company, why will it list its security? Friends, take LIC of India, it is a non-company entity. Such large entities also fall into this bucket. Thereby, this clause is extremely relevant. When LIC goes for listing its security, irrespective of how much it is earning in terms of turnover, it will be classified as a level 1 entity. Banks, financial institutions, insurance agencies, and also any other entity which is engaged in commercial, industrial, or business operations having turnover of 250 crores or more, or borrowings of 50 crores or more. So what we have to remember here is all these criteria come with OR, which means any entity which satisfies even one of the criteria, automatically it will fall into this bucket. So as you can see, it is 50 to 250 crore, 10 to 50 crore, and the residuary clause is any entity which has less than 10 crore turnover. 2 aspects I want to clarify here. When you take turnover, it does not include other income, taxes, GST. It is simply only the turnover earned by the entity. Second, when you take borrowings, it will be borrowings at any time during the preceding previous year. So a question comes, which year do we need to take? Supposing this is applicable from March 31st, 2021, you need to take turnover as on March 31st, 2020. So between in that balance sheet, what the turnover is, that clarifies into this criteria. Second, it's important to note the difference between your turnover and borrowing, where they've said borrowing at any time during the immediately preceding year. That means between April 2019 to March 2020, say in October, suddenly the borrowing increased 50 crores to be able to fall into the first category, automatically it becomes a non-company entity. The reason why they've done this logical change is because it was found some entities have higher borrowing during the year, but as at balance sheet date, it suddenly reduces so that they can avail this criteria. So very, very logical change has been made in this regard. I will also share the PPT so that you can go through these changes at leisure. Two aspects I want to quickly highlight here is, if you see the jump of what has come into this notification, before this note 31/3/2021 notification came from the institute, the turnover limit was only 50 crores for an entity to come into the large entity. But now it has been increased 5 times. So multiple entities now, which earlier did not fall into this category, will now fall into this category and avail the benefits of it. What do I mean by avail the benefits of it? The reason why Institute has come out and given these classifications for non-company entity is to provide certain exemptions. What they have said very clearly, if you are a large entity where your turnover is more than 250 crores, borrowings more than 50 crores, you have no exemption. You need to follow every single accounting standard there is. But if you do not fall into that bracket, or you fall into level 2, level 3 or level 4, then there are many exemptions provided. The reason this has been provided is, when you are a smaller company, when you are a sole proprietor, it might be very difficult for you to comply with all accounting standards, surely because of the extent of documentation involved, or the extent of expert who needs to look into your books that is involved. So logically, they've come out with these turnover criteria, which will now ease out the pain of preparation of books of accounts and filing your return of income. If you see the last one, the level 4 that is introduced newly, where your turnover is less than 10 crore, borrowing less than 2 crore, again very well done, because as I already said, whenever there is tax audit applicable for turnover more than 10 crores, so automatically when we remember, we can understand that any entity for which tax audit is not there will automatically fall into your level 4. So if you remember friends, level 1, level 2, level 3, tax audit is going to be applicable. Automatically your auditor is going to report in the tax audit report whether it is true and correct, thereby accounting standards will come. The last level, level 4, even though tax audit is not applicable, as accountants, as chartered accountants who are auditors of the company, still you need to mandatorily follow the accounting standards as prescribed. Two other clarifications when we see this level, there might be a scenario where last year an entity could have had 100 crore turnover. As of March 31st, 2020, it could have become 150 crores. Now we are aware when we see the limits. Last year it would have been a level 1 entity, but now it is less than 250 crores because of the change in the criteria. So whether it can now transition from a level 1 to level 2. Unfortunately, the answer is no. There's a very clear guidance which says any entity which ceases to be a level 1 entity has to cease to be such entity for 2 consecutive years. So this year also, let us say scenario he earns 150 crores. Next year also there's only 200 crores. Only in such scenario that level 1 can come down to a level 2 entity. This is merely for someone to keep consistency in the extent of standards that are being followed. The next one is, in the event where you have an entity which was level 2, now this year went to level 3 because of the revised criteria, whether that is possible, answer is absolutely yes. All they need to do in notes to accounts, you need to mention and say it was level 2 last year, this year it is level 3. A question that comes up, now that I've said any entity which is not registered under Companies Act 2013 has to follow this, whether charitable trusts need to follow the accounting standards, whether that is mandated. And that is where we need to read the notification very, very clearly, friends, which says that any entity having commercial, industrial or business, and then they give a turnover and borrowing criteria. When we take a charitable trust, automatically, most cases, there is going to be no commercial, industrial or business. It is purely there for charity. Thereby, a softer stance is taken by the ICAI. They need not follow accounting standards. However, even if there is one activity which is of commercial nature, automatically they need to come into this criteria. You need to check which level that trust falls under and accordingly ensure accounting standards are being followed. Let us take a scenario. You have a hospital. For construction of hospital, the charitable trust is there, but eventually they start renting out the beds to patients, wherein they earn some money. This will be considered as a commercial activity. Let us take another scenario where an entity is only doing charity, but it earns some money which puts into FD and earns some income from that. In my view, that is still only mobilization of savings, so you can still take the standard accounting standards are not going to be applicable. Now, having understood all that we have spoken through in terms of applicability of accounting standards, let us understand what relaxation is provided by the institute in this regard. As I already said, friends, level 1 entity, large companies, more than 250 crore turnover, more than 50 crore borrowing, no exemption. All accounting standards need to be followed. For level 2, level 3 and level 4, many exemptions are given for practical aspects. Now, if you see the screen, AS1, AS2, AS4, 5, 6, 7 and 12 applicable to all entities, which is your disclosure of accounting policy, inventory, revenue, property. It is going to be applicable for all entities naturally because these are bedrock standards. Now, any accounting, any entity need to follow this to have a reasonable basis in which the financials are drawn up. But whereas if you take cash flow, it is not applicable for level 2, level 3. If you take AS10 property, plant, equipment, AS11, it is still applicable, but certain disclosure exemptions are given. So let us first understand a snapshot of what standards are applicable, what standards are not applicable, and then I will take you through the specific disclosure exemptions that have been provided. If you take borrowing costs, again, Rashi is going to be applicable for all because many entities are going to have. But if you notice between AS17 to AS29, very few standards are applicable to your level 3 and level 4. This is a quick summary of what standards are fully applicable, what is not applicable, and what is applicable with disclosure exemption. I want to remind you, friends, why there is a significant changes. Earlier, more than 23 standards were applicable for your level 4 entity. Today, it is only 8 standards, therein significantly relieving these entities from compliance and disclosure requirements. Straight up, all the standards you see on the screen are not going to be applicable at all. Very practical. If you take interim financial segment reporting, naturally, when you are a smaller proprietor or a partner, you are not going to have these kind of transactions. Cash flow is going to be a lot of work in terms of preparation. So all these standards are not going to be applicable for your level 2, level 3 and level 4 entities. Let us take an example of why following accounting standards is very significant. Now let us take a scenario. I am a chartered accountant or I am a doctor. Most professionals keep their books of accounts in cash system of accounting, wherein as and when they receive, they will account, as and when they pay, they will account. However, we are all aware, as per provisions of accounting standard 1, accrual is one of the fundamental accounting assumptions. So now, after we have now understood what is going to be applicable for a non-company entity, whether we have to go back to the chartered accountant's book and make them redo it in accrual form. Is that so? That is how significant and applicability of accounting standard will change our perception of the manner in which we see the books of accounts. That is where I want to take you through one clause. So whenever we have a non-company entity, typically there is no statute which will guide them. Therefore, nowhere they will be required to follow a specific system of accounting. Now, that professional chartered accountant will be filing this income tax return. Thereby, the provisions of income tax will be liable for him. Section 145 of the Income Tax Act approves both cash and accrual system of accounting. Thereby, as accountants or auditors, we need not negate the cash system of accounting, but we still need to comply with provisions of Accounting Standard 1. This is a very significant standard, my friend, which require a disclosure requirement. So you need to very specifically say in the notes to accounts that it has been followed through cash system of accounting. Now, typically, from review of multiple non-entity accounts, nobody prepares this notes to accounts, but today I want to highlight it is mandatory. Every non-company entity is required to have notes to accounts. AS1 very specifically requires you to mention all the accounting policies. Especially now, ICAI has also given a notification and very clearly said that in the notes to accounts, you need to mention that it falls into this non-company entity, which level it falls into, what exemptions are applicable to it. Let us take another scenario where application of accounting standard becomes important. You have a retail owner. He started as a sole proprietor. All this while, his assets he was going through SLM. Now this year he says, I'm having very high depreciation. My loss is very high. I want to change the method of accounting. So the auditor goes through it. There's a reasonable estimate. So he says, okay, you can go through WDV. Now whether this will be considered as change in accounting policy or estimate, and why I ask that, friends, whenever there is a change in accounting policy, your entire accounting will change, because to the extent it affects, there is a difference. You have to take it to the opening balance of your reserves. Whenever there is a change in estimate, it is only a prospective treatment. That is where knowing the accounting standards become important. Revised AS10 property, plant and equipment clearly says change in method of depreciation, change in useful life are only accounting estimate. Thereby, today, if that non-company entity, the sole proprietor wants to change this method, you can allow him to change it without touching your opening reserves. You merely need to pass your depreciation entry in the profit and loss account and only give it a prospective treatment. Earlier, before 2017, it was retrospective. Amendment came in the accounting standard where it made prospective. Very, very significant to apply the accounting standard before we make any changes to profit and loss. It matters because based on the profit you are arriving is how the income tax takes your accounts for the payment of income tax. Multiple authorities, a GST authority is going to be involved in reviewing your books of accounts. As I already said at the start, there are certain disclosure exemptions given for level 3 and level 4. It was felt that they were smaller entities. We cannot burden the management or the accountants to give more disclosures. What are these exemptions? AS10, where already it was considered to be an encouraged disclosure. In the main standard itself, even companies could opt whether they want to disclose it or not. Now they've said you are exempt from disclosing carrying amount of temporary idle property, plant equipment retired from active use and not held for sale. Now, typically, friends, this is quite redundant because not every company already shows this standard, but however, you can exercise this exemption. Second is with respect to AS11 in terms of foreign currency risk management policy. Entities are required to disclose the policy in the notes to accounts. Level 3, level 4 are exempt from doing that. In terms of impairment, you need not show the movement of how much loss you have recognized and all those certain aspects for AS26. Now, what I want to remind you, these standards are applicable in full to all your entities, only the disclosure has been exempt. A very common question I'm asked in terms of the times we are living in. Let us take a scenario where your plant and machinery is not working because in times of corona, most of the factories are shut down. The client comes to you tomorrow and takes your advice on accounting and says whether I can avoid taking depreciation for the period during which we were under lockdown, because anyway my plant and machinery was not working. That is where the significance of accounting standard plays a role, which very clearly says when you arrive at the useful life for depreciation, already takes into consideration wear and tear, technological obsolescence, efflux of time. Thereby, even though you are on lockdown, you still need to recognize the same depreciation because it is assumed that when you arrived at this depreciation, you already considered these factors as given in your accounting standard 10. There is one significant amendment and exemption provided under AS15, which I want to discuss a little in detail, which I'll be doing it in the ensuing slides. Certain other disclosure exemptions are in your lease accounting in terms of what you need to show in the notes to accounts, AS29. So as you can see, friends, this is not just relevant for a chartered accountant or an auditor. It is even more relevant for the accountant because he is the one who is going to discharge the responsibility of preparing notes to accounts of any entity. So you need to keep in mind from today onwards, any non-company entity, you need to have your notes to accounts like how you have your company entity. In fact, at this juncture, I have to appreciate WIRC, who has given a publication which is available online as a model financial statements and notes that one needs to have, which is worth downloading and understanding for your clients. The one aspect I wanted to cover a little bit in detail is your AS 15 in terms of what exemption is given. AS 15 is for employee benefits. Now we are all aware there is one aspect called as a leave encashment that every entity, whether company, non-company, gives its employees. Now let us take a scenario where you are allowed, say this year you are allowed 20 days leave in your entity, and supposing you do not avail that leave, it lapses. So next year again you will be given 20 days. If you don't avail, it lapses. Now this is very straightforward. It is called as a short term, and you need not do anything in this regard in terms of accounting for it. Let us take a second scenario which many companies follow, which is going to be a scenario where this year they give you 10 days leave. You do not avail it because of Corona, you're all at home, nobody is availing the leave. Your company says, don't worry, the same 10 days you carry forward next year. So this year you have worked for 10 days because you do not avail that 10-day leave. Next year you avail this 10 days and you work only for 290 days. Now both years you are still being paid the same salary irrespective of what you are taking forward. Thereby automatically the computation of how much money the company needs to pay year on year on a consistent basis is going to be complicated. This condition is called a non-vesting, wherein it is going to be a long-term aspect of how you avail the leave. Automatically, if you are an entity that has more than 50 employees at any point of time during the year, you need to mandatorily get an actuarial valuation. Not every entity obtains this. It's extremely critical to insist on this. Let us take a second scenario where your company says, okay, you can carry forward your leave, and when you retire, you can encash it. That is, you don't just take 10 days, 20 days leave next year, you can still carry it forward till the end of your retirement. And at the time of resigning, you can get money's worth for it. Automatically, when you have such complex structures, you need to ask for an actuarial valuation, whether it is an company or a non-company entity. In my experience, while actuarial valuations being obtained for your companies, very few non-company entities obtain it. It is extremely critical to understand. Second aspect is going to be a gratuity. Now we are aware even if an entity has only 15 employees, gratuity becomes applicable. So automatically accounting for gratuity is important. The one exemption is if you are a level 4 entity, you need not do anything at all. You need to worry about getting actual valuation, but you still need to account for the gratuity with a reasonable estimate. If you are a level 2 or a level 3 entity, and if you have more than 50 employees at any point of time during the year, then it is mandated for you to get actuarial valuation and then only account for gratuity and pension. So please remember, why this exemption is provided for smaller entities is it is found that when you go for an actuary, it is a little expensive. So the institute did not burden them with actual valuation. However, accounting for it is still mandatory, irrespective of how many employees you have. And secondly, when you have more than 50 employees, you need to ensure you get the actual valuation. What happens if actual valuation is not obtained? The auditor will mandatorily qualify your report unnecessarily. Your report is going to be a qualified report. It might go to banks and financial institutions and might not be favorable for a non-corporate entity. Certain other accounting standards, which is going to be your AS 21, 23, 25, 27. These are typically standards which pertain to interim financial reporting, joint venture, and consolidated reports. Now, naturally, when you are a non-company entity, very few non-company entities have these transactions. So the guidelines clearly provide, unless and otherwise, these transactions become applicable to you, these standards are not applicable for non-company entities. When is it applicable? Let us take a scenario where you are an individual. you enter into a joint development agreement. Automatically, you form a joint venture for that property development. Then, even though you might be a level 4 entity, even though the turnover is less, these standards will become applicable to you. Last, of course, is going to be exemptions provided for level 4 entities. So we are aware level 4 is your micro entities. So they enjoy many more exemptions than the other two entities for practical aspects. You have your amalgamation is exempt, certain exceptions in impairment accounting, which I will quickly cover. And the most significant exemption given for level 4 entity, they no longer need to follow provisions of deferred tax in your accounting standard 22. Now we are aware that accounting standard 22 talks about your current tax and your deferred tax, where it is mandatory for every entity to recognize deferred tax. Now they've come out and said, if you are a level 4 entity, do not worry, you no longer need to determine your deferred tax liability or asset for your balance sheet or profit and loss account. Very, very logical and simplified way of reporting for a level 4 entity when it comes to accounting. Now let us take one scenario where all this while it was a level 3 entity. Now because they've enhanced the turnover criteria, earlier it was 1 crore, now it is 10 crore. So automatically this year an entity is going to fall into level 4 because of this notification that we see. What do they need to do? Now we are aware when you are level 3, you will be having deferred tax. What can be done? A one-time transitional requirement has been provided in the notification itself, wherein when an entity shifts from a level 3 to level 4, whatever deferred tax asset or liability adjustment can be done to the opening balance of revenue reserves. Very, very important provision and a condition worth availing this year, because what you have to keep in mind, friends, in the event where as an accountant you are not aware of these provisions, as an auditor you do not know this notification has come and you forget to make this transition requirements, very specifically it says the minute an entity opts to follow an accounting standard, it is mandatory for that entity to follow it on a year-on-year basis. There are many practical audit issues that come up when we talk about these accounting standards of how we apply them. Owing to paucity of time, I'm going to cover just 2 or 3 issues which in my view are important. Very common scenario that we are going to undergo this year is for smaller entities, we are aware when they get an order, it is not going to be a specific contract, it is mostly verbal, oral communication that they get. So in a scenario where a customer goes under, believing him, you have bought many items for your shop, you are a non-company entity, what happens to that inventory? I say very specifically given in the guidance note, in the event where you made inventory to order, but that customer does not want it any longer, you do not need to write off. You need to first check if that same inventory, you can sell it to somebody else. If it is saleable, you can continue recognizing as inventory. In the event where you cannot sell it, you made it so specific to that customer requirement, you need to write it off in your books of accounts. Another significant application of accounting standard, especially for the 31st March 2021, is going to be following AS2, wherein you need to determine inventory at lower of cost or net realizable value. While we are all aware of existence of AS2, very few people implement the NRV because so far there is no necessity. But however, today, because of Corona, multiple non-company entities are suffering losses. Multiple of them have inventory which might not be saleable at a price at which they want to think it is saleable. Let us take your Reliance, a giant. They have recognized up to 4,000 crore loss because of the recognition in NRV. So definitely a very, very significant aspect that needs to be observed for entities following AS to ensure that they follow AS2. Now we are aware whether you are a small entity with even 20 rupees revenue, you need to follow AS2. Certain accounting standards are applicable to all entities, so please ensure that is being done. Now when we take AS9, practical scenario, you might have delivered the product, you might have delivered the service, but today you are sure your customer does not have enough funds, your customer is rethinking whether he is going to continue his business. In that scenario, whether you will recognize the revenue or not, the answer is there in AS9, friends. Very, very significant issue. Especially we noticed this during times of COVID, and it was felt that practically I need to highlight this. Whenever there is an uncertainty of collection, you can postpone recognition of revenue. Thereby, if the client or if you're accounting for a client, if the revenue, you are not sure if the client is going to pay you, the customer is going to pay you, you can defer the recognition of revenue as per provision of AS9. Now, having understood the different accounting standards and applicability, one common question from non-company entities. Now, when you have a company, very clearly you have Schedule 3, which tells you how a balance sheet should be done, Schedule 2, which tells you what depreciations to take. But for a non-company entity, there is no definition in this regard. So more likely than not, every non-company entity takes your depreciation rate same as the income tax rate. Is this correct? Whether they are allowed to do that, or does AS10 say something else? Again, friends, very practically, you are allowed to do that. You are allowed to take whatever depreciation rate that income tax is. However, in one scenario where you feel there is a significant asset that is added, or it is very different from what the company usually makes an addition for, definitely question for an expert opinion within the company, if it within the non-company entity, if it is a smaller entity, for a chartered engineer certificate to understand the useful life. So it is recommended that we blindly do not take whatever is there as per income tax, but also understand more specific aspects. AS16 in terms of borrowing costs, as I already said, borrowing costs applicable to all, there are no exemptions. One aspect we need to keep in mind, during the time of lockdown, where your assets are not functioning, the interest that you otherwise capitalize as per AS16, you cannot capitalize. When there is a suspension, you cannot capitalize such asset. The last aspect I want to cover is AS28 impairment, wherein there are certain exemptions provided to your level 3 and level 4. For level 4 entity, this standard is not applicable at all, so you need not worry. For level 2 and level 3, certain exemptions are provided. When we take impairment, generally a company is required to follow impairment accounting when there are indicators of impairment. What are these indicators? Your market condition, economy is down. Today's time, automatically you can take every entity is going to have an impairment indicator. Now, what the standard says is, in the event where impairment indicators are present, then you need to value the recoverable amount of the asset, because all this while we are aware historical cost method, you'll be recognizing every asset. Now you need to understand what the recoverable amount is, which is also defined in the standard to be higher of value in use or fair value. Now, what is this fair value? This is a little complicated computation where when you compute your value in use, there is something called as a present value method, where you need to estimate 5-year projection, you need to arrive at discounting, and then you need to arrive at the present value of asset. It was found that this is a complicated computation. So when you cannot burden a non-company entity to do so much into the workings, verification, and have experts do it for you, thereby the institute has come out and said, if you are a level 2 and level 3, you still need to follow AS28. You still need to assess, but you can use a reasonable estimate and assess what the value in use is. You need not go through the whole present value technique and all those aspects. If you are a level 4 entity, this standard is not going to be applicable to you at all. The last standard, of course, is going to be AS28. There is no exemption provided to any of these entities. We are aware provision is very, very critical, so you need to automatically follow the provisions of AS29. One exemption is provided in terms of your disclosure exemption, which says that you need not show opening balance, movement, closing balance in the notes to accounts. Again, practically, it might be difficult for smaller entities to arrive at these values, so they have exempted for level 4 entities in terms of this disclosure. Having said that, I think owing to paucity of time, I would wrap up my session for today and probably spend 5-10 minutes if there are any questions in this regard. One reminder is, we assume whenever we see accounting standards, it's not integrated with the books of accounts. Let us take one scenario. Now, we are aware last year, during the time of the first wave when the pandemic happened in June 2020, the government came out and said, whichever entity falling into specific criteria where you have 100 employees or more and you have to remit your PF, the government came and said, we will remit the provident fund on the employer's behalf. Many entities availed this provision, including firms, proprietors, wherein the government will pay for it. What we need to remember, this is considered to be a government grant which needs to follow AS 12. So that is how integrated every transaction you have, whether it is a big company or a small entity, will invariably come into one of the accounting standards. So it is imperative for us to understand which level we are dealing with. You can easily determine this because it is going to be your last year criteria. So this year now itself you can determine which level and accordingly ensure that all accounting standards are being followed accordingly. So with that, I would like to conclude my presentation for today. I would again like to thank WARC and AIA for having me here to address such an august gathering. It's been a privilege and an honor for me. Thank you so much. Stay home and stay safe.
Organizers, can I have a question? Hello?
Yes, sure, sir.
Divya ji, I am G. Soral. Sorry, I can't be present on the video. Excellent presentation from your side. I really enjoy it all through. In fact, I have a related question since you are from the Accounting Standard Board also. Please comment on what is the future of accounting standards now when the institute has already adopted Ind AS 1. Second is that now we already have one IFRS on the small scale industries. Whether there is any intention of the institute to adopt that standard, kindly revert on that. Thank you.
Okay. Thank you, sir. So basically, when we talk about non-company entities, sir, I think it is going to take some time for the IFRS or Ind AS to percolate into that level. The reason being the extent of compliance and also the extent of expertise involved in adapting those standards by a smaller entity is going to be significant. Because in terms of when I said right now they only file income tax returns, most entities are not even required to get their books of accounts audited. This is more from a regulatory aspect that has come out where now accounting standards are applicable. I think the first significant step by the institute is making standards applicable mandatorily, which is why they are also disseminating this knowledge and information to all professionals and accounting bodies to ensure that even though you're a non-company entity, you now need to follow accounting standards. And once this becomes a norm, maybe eventually they will be able to integrate your Ind AS and IFRS requirements too.
Yeah, how about, I mean, that was also my question. You know, at the international level, now we have a separate IFRS for the small scale industries. Is there any thinking going on in the ICAI to think about that standard in India?
I think Manish sir will be the more relevant person to highlight, throw light on this aspect. But in my view, yes, sir, eventually I'm sure it is going to be integrated as one accounting standard to also align with the global levels as well. Are there any other questions that you would have for me, sir?
Is there any system whereby we can collect questions on the chat?
Yeah, even I'm unable to see that.
Yeah, because this software I am also not so aware. You know, any person who is coordinating this session, kindly respond to that.
Arpitji, are you available?
The person who was coordinating, what was his name?
Arpit, sir, from anyone from WIRC available, please? Okay.
Yeah, somebody is there? Hello? Nobody is there.
Okay. Maybe I will.
Give them a ring? Hello?
Yeah. Yes, sir. You can.
Yeah, I'm giving them a ring. Okay, just wait.
Yes, sir. Definitely. So I think that maybe in the meanwhile, I'll probably just cover 2-3 other accounting standards which have an impact on your accounting for non-company entities. One
Kindly,
is
kindly
your,
carry on. Kindly carry on. I'm in the meantime trying to touch upon them. Kindly carry on.
yeah, sure, sir, sure, sir. So one is going to be your AS1. As I already said, most of us discount AS1 thinking it is a mere disclosure standard. In my view, it is one of the most critical standards wherein you need to very clearly say what the entity is following in terms of your accounting standards, whether it has been complied with. Many times we notice in this AS1 in the notes to accounts, certain changes are made which is against your accounting. Now let us take a scenario. A company is providing online subscription. In your revenue, AS9, as per your disclosure in notes, and accounting is done wherein you say revenue is recognized whenever subscription is collected. Now please remember friends, this is a wrong disclosure. You need to very clearly say revenue is recognized when it is accrued or when the service is rendered and not on collection. So these are the significant impact of changes that are made in your notes to accounts, which will impact the way in which a person reviews your financial statement. So when you go through AS1, first and foremost, you need to ascertain whether that entity is on a going concern basis, one of the fundamental assumptions of accounting. Why is this important? In the event where you feel that entity might not continue in the next 12 months, then automatically whatever numbers you present in the books have to be on realizable value. So whatever asset, inventory, everything, you cannot recognize it at cost. Going concern is a very significant assumption when you have. So you need to mention in the notes to accounts, irrespective of the size of the entity, that it is going to be going concern, wherein you see foreseeable next 12 months the entity is continuing. Why is it important? Please remember, the management or the accountant is responsible for the notes to accounts. All the auditor is responsible is for issuing the audit report or giving his opinion. So when the management represents and says it is going concern, you have to remember that for the next 12 months, the non-company entity has to continue. It cannot be a scenario where as on 31st March you say it is a going concern, then later you take a scenario where the company shuts down or the non-company entity shuts down within 3 months. So AS1 is extremely critical. From today onwards, please ensure you educate even the non-company entities to have this notes to accounts and the accounting policies followed very, very clearly. Another scenario that we come by is your AS3, which is your cash flow statement. Even though I've said AS3 is not going to be applicable for your non-company entity, there are certain aspects when it comes to cash which needs to be determined. Now let's take a scenario. During Corona, an entity has availed something called as a moratorium, wherein they need not pay interest to the RBI for a certain period of time. They were allowed that exemption. Or a scenario where because of Corona, even though that entity did not avail moratorium, they are unable to repay the loan as per the provisions of the clause. Now, in this scenario, as consultants, advisors, what we need to check is whether in the original loan agreement there is any clause which says breach of covenant. Now, typically, when you do not repay for a certain period or you do not pay interest, even though it's a government regulation, if the entity still does not pay interest, it becomes important that if you negate any of the debt covenant clause, then that loan that you consider as a long term might become a demand loan. This will change the way in which your debt equity ratios are computed, your future loans are availed. So whenever you have an entity going through your loans or borrowings, please ensure to check these covenants and ensure that they are accounted for properly. The next aspect that I thought I will quickly touch upon is with respect to deferred tax. Now we are aware that significant exemptions are provided for a level 4 entity wherein you need not recognize deferred tax. But when we take any entity between level 1, level 2 and level 3, one creative accounting that is happening in the books of accounts with respect to deferred tax is recognizing something called as a deferred tax asset, wherein when a company is earning loans for a significant period of time, something called as a deferred tax asset is being recognized. But how many of us are checking whether there is virtual certainty of earning profit? Why am I saying this? Very clearly, AS 22 says whenever an entity is making loss, if it is virtually certain that in the future it will definitely earn profit. In that scenario, you can take something called as a deferred tax asset. But in the event where, let us take the case of Uber. Now we all take cabs, we are aware of the service. Even though Uber is a going concern, even though it has a bright future, what we need to keep in mind, it is a loss-making entity and you cannot recognize a deferred tax asset for Uber because the only reason why it is sustaining is because of investment. So you need to understand the substance over form. Whenever you recognize deferred tax, it is a highly subjective matter that is often questioned. So unless you are sure that it is going to be virtually certain that that company is going to make profit, you need not recognize your deferred tax asset or liability. There is one other aspect when we talk about accounting standards and ICDS. Now we are all aware, whenever you have an entity which follows tax audit or which is filing return of income, you have income tax requiring all those entities which have profit from business or profession or other income to follow income complaint disclosure standards, something called as ICDS. Now these are very different from your accounting standards. So whenever you file for your income tax in 3CB, there is a specific clause which requires you to show the difference between your accounting standards and your ICDS. So as professionals, it also becomes important because it is going to be synonymous. No non-company entity is going to go to two different professionals. So it becomes imperative. Yeah?
Divya, we just wanted to check whether the presentation, your presentation is visible. That's okay, right?
No, sir, I've completed. I was just waiting for the next speaker to take charge. So I just thought I'll continue till then because Sural sir said he would call you. Yeah.
No problem. No problem.
Perfect. Perfect. So superb. So I can
Please
hand
go
it
ahead.
over. No, I'm.
No, no,
One
we
minute,
continue.
1 minute, Divyaji. Sir, who is there? Actually, can we check from the chat anybody who is on the channel maybe asking questions? Those who are participants. Do we have a system here?
Sure, sir. Yes, yes, absolutely, sir. After the session, we'll take the questions also.
Yes,
No,
sir.
she has already completed. Please raise those questions to her. She was waiting actually. Therefore, I called Manish.
All right.
Yeah, so
Sure,
those
sir.
questions
Sure,
somebody
sir.
may coordinate and ask them to her. She is waiting actually. Yeah.
One second. Divya madam, the last concept that you were talking about, if you can just wind that up, that's an important thing that you were mentioning. So sorry to interrupt on the deferred tax asset part.
Yes, sir. That's fine, sir. I've pretty much given the gist of it. I just elaborated a little because I thought I'll keep 15 minutes for question and answers if anyone had. So you can check and let me know, sir.
Mishra ji, if you have any questions, please put the questions. Mishra ji, please compile the questions and show it up.
Okay, sir.
Divyaji, in the meantime, what he said, you were making a very interesting comment on the deferred tax asset. Please carry on. In a minute, they may compile the question.
Sure, sir.
Let us
Sure.
utilize the time. Yeah.
No problem. So as I already said, the deferred tax asset recognition can only be done if there's virtual certainty in terms of losses. However, in the situations where you have depreciation, changes in method, changes between your income tax and your accounting computation, you can always consider applying the provisions of deferred tax as per AS 22. I think there's one question.
Divyaji,
Why is there? Yeah.
the questions are being compiled. So, one
Okay.
important thing, especially now when we see businesses, what we once thought these businesses are sustainable and they are very good, they are all, as per under the IBC, they are all being subject to null and void. They're all depreciating, they are all withering away. So, what do you think? What should our role of accountant be? Because there are some red flags that accountants can definitely identify.
Definitely, sir. I think that's a very valid point, especially at the times we are living in. In fact, in the last 1.5 years, over 250 companies opted for IBC. So increasingly, many companies are not able to sustain. That is where for us, even the basic standards such as accounting standard 1, which talks about going concern, accounting standard 4, which talks about event occurring after balance sheet date on conditions which existed on balance sheet date, you need to mention. So definitely, I think application of accounting standard today has become imperative. More or less, this has been there, but very few entities other than companies were taking it seriously. I think today, the times we live in, it becomes important because the manner in which you see a balance sheet completely changes.
Sure. So the first question is, there is no coordination between XBRL, GAAP, IFRS and Indian accounting standards.
While this is a valid question, I think increasingly what the ICAI and the standard setters are trying to do is to bridge the gap. But on a more practical basis in terms of the volume of transactions, so that's why when you see an entity with lesser turnover, the extent of application is lesser, because practically if you impose these kind of XBRL, Ind AS and IFRS to a very small shop owner or a sole proprietor, then he will 365 days he has to focus on compliance over actually running his business. So from a very practical angle, and rightly so, I think certain distinction is being made. However, friends, if you see, even when we went through the presentation today, the basic standards, your 1 to 12 accounting standards are going to be applicable for all, which is synonymous with your other international standard setting bodies also.
So then there is another question which says accounting standard on carbon credit accounting. I think it's a very important concept, but do you see any guidance note on that?
So right now, this concept is relatively new, but we are having something called as sustainable reporting increasingly that is being come up. Even if you take CSR, on Jan 21, they've come out and said for entities which have more than 10 crore CSR spend have to do something called as a sustainable reporting where carbon credit is being covered and various aspects. So what they're trying to do is right now impose it on larger entities so that the percolation can be done over a period of time. So right now, from your AS1 to AS29, there is no carbon credit, but definitely we do see this happening in the future to be included.
One very important point is human resource. Accounting of human resource. I think that is one of the most important asset for any company. We don't see this item in the balance sheet yet, and perhaps there is no accounting. So, but there has been a conversation, there has been a talk around it for almost maybe more than 4 to 5 years now. Nothing has come out. So, do you have any insight or any thought process around that?
So one thing, sir, when we talk about human resource, it's both qualitative and quantitative. In my view, the quantitative aspect is well covered with your AS15. It gives a very detailed expectation of whatever you account in terms of financially in your statements, it's covered there. As you rightly pointed out, in terms of the qualitative aspects of extent of usage, extent of social impact, that is still yet to come. Globally, many countries are imposing this. Maybe eventually we will see this being covered as part of AS15 to give additional disclosure in your notes to accounts.
Right, and there's the last question. I think, okay, they were repetitive. The last is about ICDS and the accounting standard. I think you've covered it, but maybe a closing comment on ICDS and accounting standards.
Yeah, so it's a very valid question. I want to first clarify in terms of applicability of ICDS. Whenever an entity is having cash system of accounting, automatically ICDS will not be applicable. Only for those entities who have business or profession or other income, provisions of ICDS as per Income Tax Act become applicable. Largely, if you see, there are totally 9 standards which the Income Tax Act has come out with, which is relatively the last 3 or 4 years is where the extent of reporting has come under it. Most likely, the standards of ICDS and the standards of accounting are the same. Very few aspects. If you take forex, there are certain requirement of addition, changes that are required. If you take inventory, now as per accounting standards, inventory is measured at cost of bringing it to the current location and condition. GST and other taxes which you can claim credit, you do not include it in inventory cost. Whereas if you take ICDS, income tax requires you to include it in the cost of inventory. So to that extent, there is a difference between your accounting standard and your ICDS. And when you file your income tax return in your form 3CD, you need to measure what the difference is between this and that and inform in the same.
Super. Very in a brief, I think you have given out the exact differences, very quickly. There was one question about when there is no proper content available, how do we apply ICAI's and accounting standard? Well, the answer is simple. Approach Divya ji, or approach Preeti madam, or approach Murtuza, or approach us. The professionals will help you do that. Don't worry.
Yeah,
Anyway,
and I think that's why the session for today is very important, sir. Because you might be under the impression that 29 accounting standards are applicable for any person. But today we have learned that when you are an entity less than 10 crore, you do not need to worry. Only 8 accounting standards are going to be applicable for you, which you as a business owner itself logically will be following. While you will have professionals guiding you, which will be a chartered accountant who's going to file your return of income, during your accounting itself, by logic and accounting standards, largely in my view, are synonymous.
absolutely. Oh, perfect. What a great session that we had. May I now request another expert, an IBC expert and also expert in accounting domain, our past chairperson, Preeti Savla madam, to please share her views on this topic and give a well-deserved vote of thanks to our lovely faculty from Chennai. Over to you, madam.
Thank you, Arpit. Murtuzabai, our secretary, current secretary, both Arpit as well as Murtuzabai, and my dear audience. So, as such, entire gamut on the topic has been discussed by Divya Abhishek in very well manner in the limited period of time, and I am 100% sure all the participants have gained very good knowledge, and it was a really great value added session by Divya madam. So I am directly taking to vote of thanks to her because we have immediately lined up another session on GST. So all of you agree that the session was really insightful and helpful to each one of us. So on behalf of WIRC and all the participants, I propose a very well-deserved vote of thanks to Divya madam, and I request all of you to carry with loud applause. So really, we again will call you Divya to take the session on this very dearest topic, because nowadays this accounting issues are really very critical to handle, because daily we are on ICAI as again a part of IFAC, and on that basis we are following what our International Federation of Accountants is also following as a being a member of IFAC. So we have to upgrade, the ICAI is also upgrading the standards, and on that basis, upgradation of our knowledge is also required. And with the help of your session, it was very timely updated. So thank you very much.
Thank you so much. Thank
Thank
you.
you. Thank you, Preeti madam. Thank you for delivering a fantastic session on these accounting standards, Divya. Moving on next, we all been waiting for to hear an authority on GST, Central Council member and a fantastic orator that we have amongst us. I would request my colleague Murtuza bhai to please introduce a very well-known, of course, faculty and a great orator, Rajendra Kumar ji. Over to you, Murtuza bhai.
Thank you, Arpit. It is really an honor and privilege to introduce CA Rajendra Kumarji. His achievements are huge and it goes into pages. I will try to make it as brief but cover most of the important things. So Rajendra Kumarji is a commerce graduate from University of Madras. He did his graduation from AM Jain College, Chennai. He is elected to the Central Council of the Institute of Chartered Accountants of India 1922. Currently, he is chairman of GST and Indirect Taxes Committee, vice chairman of Committee on Management Accounting, deputy convener of Members and Students Service Directorate, member of Disciplinary Committee Bench 2, member of Board of Studies Academic and Skill, Editorial Board, Ethical Standards Board, Professional Development, Accounting Standards Board, Direct Tax Committee, Digital Accounting and Assurance Board, Internal Audit Standards Board, Management Committee, and Committee of Members in Practice. So huge contribution on these various committees. He was also a Central Council member for the period 10 to 13. He is a fellow member of the Institute of Chartered Accountants and also a graduate member of Institute of Cost and Accountants of India. He is an independent director on board of reputed corporates. He is also appointed on the board of Central Warehousing Corporation, a reputed public sector corporation set up by the Act of Parliament by Government of India as an independent director for a period of 3 years from January 2020 onwards. He is also the chairman of audit committee of the corporation. He is also a senior partner of Sanjeev Shah and Associate Chartered Accountant. He is a member of International VAT Association headquartered in Belgium. He is the only Indian on the technical advisory group to the Working Party 9 on consumption taxes, VAT stroke GST, OECD headquartered in Paris, France. He has the unique distinction of being the first and only person in India to have been invited by OECD to participate in the second Global VAT Forum held in Tokyo in 2014. He is a member of Platforms Task Force Group of the OECD, which is engaged in research and analysis of business models and taxation of e-commerce. He has presented papers on country update on VAT and GST in India at the Conference of International VAT Association held in Madrid, Spain in 2014, and progress of GST in India and VAT in Singapore and multiple other countries in Vienna in 2016. He has been presented like on multiple forums. He's been a speaker on multiple places. He was the first elected president of International Chamber of Indirect Tax Professionals headquartered in Chennai. He was the president of the prestigious Hindustan Chamber of Commerce. He was the general secretary of Rajasthani Association, Tamil Nadu. He is the father of VAT audit in the state of Tamil Nadu. He recommended and relentlessly pursued the introduction of audit provision in the Tamil Nadu VAT Act, and Government of Tamil Nadu accepted his suggestion and introduced the audit from the year 2012. He has contributed on multiple ways and multiple forums. The list is long. The last one, the regional conference Karka Kasadara, held on November 28 and 29, 2008, under his leadership, registered a record attendance of 4741 delegates, the highest in the world till date by any accounting body. This feat has been entered in the Limca Book of World Records 2010 as the largest conference of accountants in Asia. He, like I said, has been invited on various forums. His bestseller book, Handbook on Service Tax, was published by the Society of Auditors Chennai, and the first edition was released by Dr. Paratha Sarathi Som, the then advisor to the Ministry of Finance and Government of India. So, friends, we have an expert here today, a legend on indirect tax, and let us welcome, sir. Welcome, and over to you, sir, for your session. Thank you.
Thank you, Murtuza bhai. Sir, we are indeed privileged, and thank you for taking out time and addressing us on this council. And I believe with you on board, we'll soon reach the record of highest conference when we do Wakao here in Mumbai. Over to you, sir.
Thank you very much, WIRC of ICAI. I hope I am very clearly audible. Thank you very much. Very esteemed past chairperson, my dear sister, CA Preeti Ji Savla, my brother, CA Arpit Ji Kabra, Murtuza Bhai Kachwala, who introduced me to this grand audience, and above all, my very, very dear friend for the last 2 decades, who is now occupying the position of the chairman of WIRC of ICAI, Manish Ji. In fact, Manish Ji and myself, I think we have grown up together in the area of consumption taxes. In fact, I always tell him that you are becoming the chairman of WIRC has been a great loss to the GST and Indirect Taxes Committee. Because for 1 year, we have lost a faculty in Manish Ji. So I always tell him that West would have gained, but as a committee we lost. But then we are waiting for people like Preeti ji and Manish ji to come and fill the slot of intellectual leadership in the institute's hierarchy. Esteemed friends, participants of this particular course, the members of the International or Indian Accounting Association. In fact, I would request the Indian Accounting Association now to go international. It should not be called as Indian Accounting Association. You must call yourself as International Accounting Association.
Thank you.
Open
Thank
up
you.
your membership for outside world. Chart the passage towards those countries where you can be led. Charter unknown territories for the Indian accountants to benefit. Unless and otherwise there is a legal embargo on your membership, you must now call yourself as International Accounting Association, taking a giant leap from here. These are my preliminary suggestions. Esteemed friends, I like to watch films. Now, if you ask me what I have done in all these lockdown 1, lockdown 2, etc., I have watched numerous films and I have watched certain films again and again. Films do teach us history, films entertain us, and films are a medium of knowing certain things. When I talk about films, I remember one of the very renowned Indian artist who is no longer with us. Maybe some of you may not heard his name because about 2 decades now, and some of you would have certainly known. His name is Dada Saheb Kondke. That is how we used to know him. Dada Kondke, that we used to call him. His films were very catchy films. No film can be a mediocre or an ordinary film, because the titles that he used to keep for the films used to draw crowds. So inviting titles he used to keep. And one film I remember, the film's title was Andheri Raat Mein Diya Tere Haath Mein. Now, a person who reads the title would certainly be very much interested in the colloquial meaning. Andheri Raat Mein Diya Tere Haath Mein. Kya diya? Paisa diya? Sona diya? Chandi diya? Kya diya? What is it? But you go and watch the film, the story is so interesting that one person gives in the hands of another person, a young child, and frame by frame the film takes you to interesting situations. And if you want me to say in Hindi, naye mode leti hai kahani. Indian GST is no lesser an experience like a Dada Kondke film. I must say this. The title is catchy. GST, Goods and Services Tax, One Nation, One Tax. Very catchy title. Pull the audience towards you like never before, and ensure that they stay with you with surprises after surprises being thrown at them. Friends, Indian GST, once you get into it, you'll find that it is CGST, the Central Goods and Services Tax Law, the State Goods and Services Tax Law, and you have the Integrated Goods and Services Tax Law. We have the GST Council. We have the Central Board of Indirect Taxes and Customs. We have the GSTN, the Goods and Services Tax Network, and commissioners of the state goods and services tax. This is the whole gamut of the Indian GST. We know it is one single legislation across the country, one law. If you read the Goods and Services Act of, say, Uttar Pradesh, and if you read the State Goods and Services Tax Act of Karnataka, both are mirror images, both are one and the same. If you read the Central Goods and Services Tax, again it is the same. You will find the same provisions, word by word, letter by letter. But esteemed friends, India is a federal country, and this federal country has brought in a legislation from July 1, 2017, which the world was waiting for and looking at awe. How can India, a federal country, one of the largest federal countries, with so much diversity in population, languages, culture, food, geography, infrastructure, bring a legislation like GST, which is consumption-based taxation, and make it one single law across the country? The Indian experience of GST has been an experience, or rather an example for the world to follow when it comes to cooperative federalism. If there is one country which is again a federal country like India, a much larger country like India, it is the United States of America. And the United States of America does not have a legislation like what we have the GST, which means with about 100 plus countries levying GST, levying a tax on consumption of goods or services, India stands as a unique nation implementing it as a federal country. Esteemed friends, the Indian GST law is not only the Indian law. It is based on international literature. It is based on 100 plus countries' legislations that the world is following today. India joined on July 1, 2017, 100 plus countries which implement GST in this manner. Some countries call it VAT, value added tax. Some countries call it goods and services tax. There is an international connection. And that international connection comes from the Organization for Economic Cooperation and Development, OECD in short, headquartered in Paris, France. Organization for Economic Cooperation and Development was established about 55 years ago by the developed nations of the world like United States of America, the European Union, Australia, and so on. As on date, there are about 30 permanent members of the Organization of Economic Cooperation and Development, and there are about 100 odd countries which are observer members. I recognize the presence of Professor G. Soralji, President IAA, whom I see on the screen now. Sir, I am inspired by the manner in which you spoke before all of us, and I'm inspired by your leadership qualities, and I'm more inspired because you belong to the state where I owe my roots. Dharti Dhorari, Rajasthan. I have been born and brought up in Chennai. My ancient roots, my ancestors' roots are in this particular great state in India, one of the most hospitable states, known for its hospitality, culture, color, and tradition, and Maharana Pratap ki Veer Bhumi. Thank you very much, sir.
Thank you, Rajendra ji. So nice of you. Kindly go on. I'll talk to you. I have some questions for you at the end of your session. Please go on.
They will speak, sir. Yes, sir. Thank you very much.
Yes.
Friends, India, one of the observer countries of the OECD and a member of the Working Party 9. Working Party 9 is the working party of the OECD which deals with consumption taxes. See, why I am telling history? The topic is input tax credit. Straight away, if I jump to input tax credit, it becomes a monotonous lecture which I deliver to chartered accountants. But I believe there are many accountants, accounting professors in this particular organization, and there are also many in the audience. Friends, this particular Working Party 9 deals with consumption taxes of the world. Working Party 9 lays down guidelines for taxation when consumption of goods or services happens. India is a member of Working Party 9 and also a steering committee member of the Working Party 9. To help this Working Party 9, there is also what is known as Technical Advisory Group to the Working Party 9. The job of the Technical Advisory Group is to advise the Working Party 9, which comprises of government officials representing the consumption taxes department of various countries. And these government officials bring out documents laying down guidelines on the manner, mode, and method in which the taxes shall be levied. World countries pick up these guidelines and incorporate it in their legislation. In fact, they tweak these guidelines to suit to their legal scenario, their legal framework. But the principles are common. India being a member of Working Party 9, India being a steering committee member at the OECD's consumption taxes group, and as a member of the Technical Advisory Group which advises the Working Party 9, which looks into the various works of Working Party 9, I have had a close opportunity, or rather having a close opportunity of working on these particular legislations. So well before the GST was launched in India, we started working on all these aspects. Coming from the sales or purchase concept in the erstwhile VAT era, we moved to the concept of supply. No longer the term sales or purchase is used in the GST language. It is recipient of a supply and the supplier and the recipient. These are the two words which have become extremely important in the Indian GST scenario. Now, when a supply is made from one person to another person, whether it is goods or services, the supply, if it is made for a consideration, triggers a taxability. You go to a shop, you buy 1 kg of rice, 1 kg of branded rice. The shopkeeper delivers to you that 1 kg of rice. He has made a supply of 1 kg of rice to you, which is taxable at a certain percentage. So for the purposes of taxation, there must be a supply, and that supply must be for a consideration. Where it is a free supply, there is no consideration, the GST law does not apply. So esteemed friends, unless and until there is a supply for a consideration, there is no need to read GST, close the book and sleep. But that doesn't happen. The consumption taxes are so large, enlarged, I must say, that they cover almost every strata of the society, rich or poor, aristocrat or not, bureaucrat or otherwise. Everyone pays consumption taxes, including the child in the mother's womb. I say pay consumption taxes, including the dead pay consumption taxes in various forms. So friends, when there is a supply, a tax is triggered. That supply is known as an output supply. Output supply. Now this output supply is taxable at a certain rate. In the Indian GST scenario, we have 6 different kinds of rates of taxes, 6 different kinds. In fact, you can ask me why there should not be one single rate. In no country in the world, except in 2 to 3 nations, whose size is a dot in the map of India, have one single rate, but even they are now struggling and they want to increase the quantum of rates. So every country worth its name, where consumption taxes are implemented based on various requirements of their respective nations, have more than 1 to 2 to 3 rates of taxes. But yes, more than one rate is common. In the Indian GST scenario, the common rates are 5, 12 and 18. These are output taxes. Output taxes. When VAT was introduced in France in 1950s, around that time no one knew the word value added tax or consumption taxes, nothing. No one knew these words. Consumption taxes in the last around 60 years, 60 to 70 years, has taken the world governments by storm, and the revenues have increased manifold. Now, in the Indian scenario, when the rate of tax, the output tax is 5, 12 and 18, there arises the taxability. The output tax has to be paid to the government by the supplier. So when a supplier is making a supply, when the provision store person is making the supply of 1 kg of rice, he or she is required to issue a taxable invoice. It is not invoice, it is known as taxable invoice in the GST terminology. A taxable invoice is issued. This taxable invoice is compulsory for the purposes of levy of an output tax. You can ask me, sir, is it compulsory? Yes, the law requires that a taxable invoice shall be issued and a rate of 5% shall be charged. I'm just using 5% just for our understanding purposes. 5% should be charged in the invoice. Now, once an invoice is issued, say 10,000 rupees, 5%, 500 rupees. This 10,500 becomes total of the invoice. This is the total output supply. This total output supply, when it is made to another person, the recipient becomes liable to pay you that 10,500, isn't it? Now, for the purposes of making this output supply, there is also what is known as input supply. Input. Receipt of input by the output supplier. So this person who has sold this 1 kg of rice should have purchased this rice from another person, where he would have paid taxes. He will be having an invoice in hand. He will be possessing an invoice in hand, isn't it? So when you buy goods, when you buy services, okay, those are known as input. Input which can be goods, input which can be services. Now, in the Indian scenario, there is a beautiful section. there is a section known as section 16. Sweet 16, you may remember like this. Sweet 16 is a section which contains a provision for input tax credit. Input tax. So when I buy an input, what is the tax that input has suffered? What is the tax that input has suffered is input tax. And credit means the government is allowing you the credit of that input tax. Credit of that input tax. Is this something new in the Indian GST scenario? No, it is not new. This particular method of input tax existed even during the central excise times. It was known as money credit scheme. Then it was known as modvad credit scheme. Then it was known as senvad credit. And when service tax was introduced, for some time it was also known as service tax credit, which was then merged with the senvat credit, that is central value added tax, which excise was then called as central value added tax. And even when the states converted from the erstwhile sales tax regime to value added tax, there was a tax credit scheme which was available under the VAT also, which was known as input tax credit. So it is nothing new that is introduced in GST. It was very well there. But what is new? The new is, under the erstwhile provisions, it was not contained in the act per se. It was by way of a delegated legislation in the rules. But the goods and services tax legislation contained this in the act itself. Section 16, section 17 are the two most important sections as far as the input tax credit is concerned in the Indian scenario. Section 16 gives the right to take the credit. Friends, is it the right of the person concerned, or whether the government is according a facility? As I said, prior to introduction of GST, this was a legislation which was a delegated legislation. Hence, the courts opined that it is a delegated legislation. It is not your right. It is a facility accorded by the government. But now that this provision is there in the act itself, it becomes the right of the person to take the credit. You can ask me a question, sir, how does internationally this works? Internationally also this works in the same way in which I am talking to you now. The input tax credit is allowed wherever there is an output tax liability. If 10 rupees is the output tax liability, if 4 rupees is the input tax paid by the concerned person, the balance tax payable is 6 rupees to the government. It is mathematically, it is very easy. Mathematically, it is very simple. 10 minus 6 is equal to 4. So I will be paying 10 minus 4 is equal to 6, and I'll be paying 6 rupees to the government. 10 being the total output tax liability, 4 being the input tax credit, and 6 being the balance payable to the government. Mathematically, it is very, very simple. But it is not that simple. Why? Because this 4 rupees which the government is allowing you credit, government has already collected this 4 rupees from someone somewhere. And government says, I have received this money, you please reduce it from your account and then pay me only the balance. In fact, consumption taxes like GST and VAT cannot exist without input tax credit. The very foundation of VAT and GST is input tax credit. It is one of the important foundations with respect to the consumption taxes per se. The entire schema of consumption taxes is laid on the input tax credit only. But because the government is allowing you the credit, it also brings about certain conditions, isn't it? So when you give something to someone, you don't do it unconditionally, then it becomes a charity. When you do it with certain conditions. So government also does it with certain conditions. Input tax credit is allowed provided there is a tax invoice. There is a tax invoice. So it is not the output tax invoice, it is also the input tax invoice. So for the purposes of our understanding, we will call it as a sales invoice and a purchase invoice. So a sales invoice must contain GST and a purchase invoice also must contain GST. Only both the invoices contain GST, there is an input tax credit allowable. Of course, there are certain exceptions also to this, which are like exports and so on, where certain other provisions are there. But friends, as I said, it is mathematically easy to say, but when government gives you the credit, it also holds the tail. मतलब हाथी तो चला गया लेकिन पूंछ उनके हाथ में कभी भी रखते हैं वो. So this particular tail which is there in the hand is the conditions. I told you there are two sections, section 16 and section 17. Section 17 subsection 5 of the input tax credit provisions contains restrictions, which is known as blocked credit. In fact, whenever credits are blocked, these blocked credits hinder the very mechanism of goods and services tax or VAT. But internationally, it is known that every country has blocked certain credits. Blocked credit means you would have paid input taxes. You would have paid taxes when you purchase inputs. When you purchase goods or services, you would have paid taxes. But government says that you shall not take credit of these particular taxes. Now you can ask me, sir, why the government says like this? How can the government tell? It is the government which has brought out the legislation, and based on various parameters, the government comes to a conclusion: these credits shall not be allowable unless and until there is a specific provision which is there in the Indian GST law 17 subsection 5. The credits are allowed. So those credits which are contained in section 17 subsection 5 of the Indian GST law, which are popularly known as blocked credits. Now, what are blocked credits? What are the types of blocked credits? In fact, motor vehicles. In fact, I as a chartered accountant buy one car for my office use, for my use. The provision says you cannot take the credit of that particular tax, the tax you paid for the purchase of motor vehicle. However, if you are in the business of the purchase or sale of motor vehicle, if you are in the business of passenger transport, the government says you can, the provision says you are allowed. Now you can ask me, sir, why it is like this? I have no answer to that. I can only say that the government has brought this provision and the government has legislated this, and hence I must tell you, friends, that these are provisions which cannot be questioned. You can't question it in the legal forum, that why it is there, why it is not there. It is there in the law and we have to strictly follow it. For example, construction related services, works contract related services are not allowed as a set off. When I say not allowed as a set off, that means not allowed as an input tax credit. This is the government regulation which I am talking to you about. Likewise, food and beverages supplied to employees. You go to a restaurant, you have some nice idli, dosa, paratha, puri, bhaji, and the restaurant charges you GST. You can come and account it as an expenditure, but the GST component of that is not allowed as a set off, is not allowed as a credit, which means that purchases which you made of the consumption of those particular services which you had in the restaurant cannot be allowed as a set of no credit is available. Likewise, if you ask me, goods which are lost, goods which are stolen, goods which are destroyed by any natural calamity or so, credit is not allowed. The principle here is when you are buying something, it must generate an economic activity, and that economic activity must result in payment of an output tax. This generate an economic activity I derive from the words in the course or furtherance of business, which means that when I pay an output tax, unless and until I become liable to pay an output tax, I am not eligible to take any input tax credit. That is why goods lost, stolen, destroyed, written off, or disposed of by way of gift also, the credit will not be available. The sum and substance here is there an economic activity which is generated by the input? Unless and until the purchase of inputs leads to an economic activity called an output and a tax is levied there, the input credit is not allowed, friends. Now, this particular section 17 subsection 5 is a very crucial section in the Indian context. The details of credits which is available, and the blocked credits which are available in section 17 subsection 5 has to be very closely looked into. I will always say that whenever the concept of input tax credit is being discussed, focus should also be on the blocked credit mechanism. Every country has it, and sometimes it is so confusing. In fact, I have gone through certain legislations of various countries. In one of the countries, the country name is Malta, M-A-L-T-A, Malta. The input tax credit, blocked credit, the law says credit will not be available on recreation, amusement, and leisure activities. Now, look at these words: recreation, amusement, and leisure. Now, general English, all the three appear same, isn't it? But the law uses these three different words to say where credit is available, where credit is not available. And Malta being a small location in the European Union, this particular nation thrives on tourism, thrives on hospitality, and thrives on casinos. In fact, Malta has about 5 lakh population, and it has more cars than the population, they say. So friends, the input tax legislation also comes with one more facility of input service distributor. Now, what is this concept? The concept is this. Let us take the case of State Bank of India. The State Bank of India has its headquarters in Mumbai, and it has some 10,000 plus branches across the nation. Now, when the State Bank of India purchases services and uses these services for the purposes of its head office, esteemed friends, these services are used not only for head office but also for across the branches. And these branches which are there across the nation are serviced by the State Bank of India headquarters, and the services are distributed, isn't it? And hence the tax paid on services is also distributed. So esteemed friends, this is the concept of input tax credit which I have presented before you. I just take a minute's break.
Hello, Rajendra sir. Hello.
Yeah, he mentioned that he will take a break for a minute and coming back. Yeah, he
Yes,
has
sir,
come back.
I'm here.
Okay, sir. Okay.
Yes, sir, I'm here. So, esteemed friends, when you look at the Indian GST as a spread, each month a GST council meeting is held or was held. Maybe there was a break because of Corona, etc. The next meeting is going to be held very soon. The government, by way of rules, brings in certain restrictions also, by way of rules, but they cannot bring restrictions with respect to input tax credit because it is there embedded in the act itself. In the act itself, the government cannot suddenly rise up and say, no, I will not allow this credit unless and until it is a blocked credit. So if any amendment has to be made in the input tax credit provisions, the change has to be made in the act and not in the rules. The Indian context of GST and the GST Council, which is now a constitutional body, because Constitution contains the establishment of a GST Council, which is more or less similar to the EU VAT Council, the European Union's VAT Council, which is headquartered in Brussels, the European Union's the capital or the parliament which sits there. So the Indian GST Council and the EU VAT Council are more or less the same. The EU VAT Council looks after the legislation and taxation of the various countries in the European Union, and the GST Council recommends the rates, recommends various amendments, recommends various levy of taxes in the Indian context. So one thing is certain, an input tax credit ensures that from the beginning till the end, the tax incidence remains the same percentage. If it is 5, if the tax rate is 5%, and from the beginning till the goods are delivered to the end customer, if there is a free flow of input tax credit, free flow of credit available, then the incidence on the customer is only 5%, only 5%, because the previous taxes paid are already reduced. It has an impact on the price also, but where there arises a break, break by way of what? Where a person is exempted because his turnover is not more than the turnover prescribed for taxation, then he or she need not levy the tax because the person is not registered. Now, once a person who is not registered supplies inputs, supplies goods or services to an X person who once again is going to supply, and he is an output supplier, and since he has got no benefit of input tax credit as he will not possess any taxable invoice, friends, there is a distortion. And like blocked credits are also distortion under the GST structure. There is a manufacturer who is constructing a factory, who is constructing a new factory. Construction activity goes on. Cement is purchased, steel is purchased, sand is purchased, bricks are purchased, services are purchased. But what the law says? The law says no input tax credit on construction and works contract. So this becomes the cost. When an input tax credit is not allowed, it becomes the cost of the business, which impacts the price. That is the reason why world over, businesses have always fought for what they call it seamless flow of credit, continuously from X person A to Z. Continuously from A to Z, the businesses have always recommended that there should be a seamless flow of credit. When seamless flow is broken, it impacts the prices. It impacts the price of the commodity or the service per se. Friends, having said this, I must say that it is always a challenge to look at the ITC provisions. As a professional, when I render service to my client, which is GST related, I always look into, or I always suggest that we must look into the input tax credit provisions. Because when an accountant is taking the credit, he or she is not bothered. Whatever is there in the invoice is immediately taken as a set off and output taxes are paid. Now, whether the ITC taken is right or wrong becomes sometimes a subject matter of debate and discussion with the department or within the chartered accountants also who are doing the audit of that particular concern. So input tax credits have always been a matter of concern, sometimes debate, and sometimes great relief to the businesses who actually take those credits, because it impacts their profitability. Because it impacts the price, the profitability is also impacted. So having said this, friends, I have to conclude by saying that the very fulcrum or the foundation on which a consumption tax like GST rests is input tax. If there is no input tax credit, there is no value added tax, or what you call it GST, and the whole system can fail. So unless and until there is a system of input tax credit, of course, with block the credits being recognized in the law, the price becomes because of taxes, the prices may have a cascading effect. And to cut this cascading effect only, provisions like input tax credit have been devised and introduced in the legislations. Friends, I know it has been a general lecture that I have given to you because of the fact that an input tax credit can be a discussion of one full day with the provisions of the various legislations and so on with us along with the rules. Given the time which is available with us, a basic lecture like this hope would have helped you. I sincerely thank the Western India Regional Council for reposing confidence in me and giving me this wonderful opportunity of interacting with you. And also to the Indian Accounting Association, which is so soon going to be International Accounting Association. Professor Soranji, who was here, and whom I see now Jayesh Bhai, the treasurer of WARC of ICAI, also appearing before me. Sincere thanks to each and every one of you, and I will gladly take any question on consumption taxes in general, the GST in India in particular. Thank you very much. Over to the organizers.
Thank you. Thanks a lot, sir. Thank you for a wonderful session. And this conversation really opens up a lot of avenues for all of us and gives a deep insight into this beautiful topic, which has kept people always wondering what is going to happen next. Every council meeting, and there is something new that they have to work on. So I think it has become dynamic. So people who say that we are getting bored by monotonous stuff, I think GST is ensured that they are never bored. They are always put to task and work and keep interpreting and keep working around. So, anyways, in a lighter vein, Mishaji, if you have any
I would like to ask a question.
Soral sir, please.
Yes, sir.
Yeah. CA Rajendra ji, I am G Soral. Actually, I was all through here only. My video is not working properly, but I was listening to you word for word all through. It was a very interesting lecture, the way you presented the aspects of input credit. One thing was very much matching with your introduction and your delivery, that like we in the teaching fraternity say that, somebody who has digested the subject and now delivering it. It was appearing in your speech, something like that. Like you have been introduced, you are the only one Indian who represented the country at the world level for VAT and all. So first thing is that it was a very interesting lecture, and for that I congratulate you being a co-organizer. Second thing is that what you initially said, I would like to comment on that. The Indian Accounting Association is, as you may be knowing, was found in 1969, and at the moment we have about 7,200 members all over the country. But as you were pointing out, there is no restriction for us to go international. In fact, right now we have a large number of international members, And in the fray this current year, we are planning to have some branches outside India also. So
Great, sir.
I mean,
Wonderful,
that is one
wonderful,
information
wonderful.
which I wanted to give to you. And one question now I would like to put to you, and in fact to inform you something which you would love to be listened from me, being a teacher. As you mentioned, and you have been involved in the whole system of implementation of GST here. That yeah, I am appearing on screen also now. In
Wow,
fact, there is
fantastic.
some problem.
Sir, amazing. After finally the end of session, we are now able
Yeah. In fact, I had to call my student. He has come over from 15 kilometers driving, and he could switch on. So, Rajendra ji, my question to
Oh
you
my
was,
God.
and I was going to inform you that right from the 1st July 17, when you implemented, through you it was implemented in the country, the GST provisions, we implemented it in our syllabus actually. Because earlier at our graduation and post graduation, we were teaching all other indirect taxes which ceased because of being GST coming in. So my vice chancellor of that time is definitely needs collect for that. That he permitted us to implement right from 1st July 17 GST in our all syllabus. And you can understand that how difficult it might have been for the teachers initially to accommodate with it. But I would also like you to comment on that. Do you really find that, I mean, with the implementation of GST, whatever it has been claimed that cascading effect is not there, and we have moved to an international system of taxation, and we have become more efficient. I mean, what are your comments on that? And where is the journey? What is the journey ahead? Kindly, thank you.
Very good question, sir. In fact, you have asked a very futuristic question also, along with the present situation. In fact, if you ask me in particular, sir, the implementation of GST has resulted in, to a certain extent, centralization of taxing decisions in the country, centralization through the GST Council. Now, whether it is good or not good, I am not commenting on that. Centralized decisions are being taken, and no single state has claimed that their revenues have decreased because of implementation of GST. The GST, coupled with the input tax credit provisions, has only drawn into the system many businesses which hitherto were never within the system. Because of the technology also, the electronic mode and medium by which the GST is implemented, people can no longer go out of the system. But then in a vast country like India with so much diversity, there is a possibility of distortions. Why I am telling there is a possibility of distortions is because when the chain breaks, when the input tax credit chain breaks, and the other next person is not able to take the credit of that particular of the tax of the supply which he is making, there is an impact on the price. So, and in a country, vast country like India, distortions do happen, chains do break. And sir, GST is a dynamic tax. It is not static. No country in the world can claim that it is a static tax. No country. You can see the history of any country. GST has always been, the consumption taxes like GST have always been taxes which are dynamic in nature, which change with the economic changes happening in the country, which change due to various geographical changes that happen in the country. Sometimes consumption taxes become a tool in the hands of the political leadership of the country to implement or not to implement certain decisions and schemes. And sometimes GST, that is the consumption tax, is also used as a tool to implement certain social objectives of the government. In fact, it is so flexible that it can be used in any manner which the government and the bureaucrat wants. And in a vast country like India, with so much diversity, it becomes very, very easy, very, very easy. So I would only say that the Indian experience till now has been like ups and downs, etc. And it will continue to be so. I mean, you cannot expect that this tax will give you peaceful times. I mean, when I say peaceful times, I'm not telling worrying times, or why I'm paying tax, or not that. There will be changes. As businesses change their mode, manner, method of supplies and deliveries, there will be changes in the tax also. But tax cannot keep pace with those changes that happen. Changes in businesses happen fast, but changes in taxation happens little slow because there is a process which is involved and you can't do it overnight. And when this scheme is introduced by way of an online mechanism, and online, all of us know, those who never knew online before 2019, I mean before 2020 March, now very clearly know online, what is online and how online can be disruptive, how online can, I mean, how your computers can fail, how your internet can fail, and so on. So for practitioners, for businesses, they will always be, there will always be testing times, interesting times. But then when it comes to academicians like you, and sometimes I'm also an academician in this, we are at least certain that there is one law which in the entire country, where when you teach in Rajasthan is what I teach in Tamil Nadu.
Correct.
So that is the biggest victory which India has displayed to the world, that with so much diversity, we can implement a tax like GST with one single legislation.
Exactly.
See, European Union, for one product X, France may charge Y, maybe 5%. Germany may charge 8%, which is not permitted in India. They are a union. They are also bound by their internal regulations, etc. But then when it comes to rate of tax, they are different. They are different. But India has shown to the world that a federal country can come out with a law with one rate of tax. See, the North India's principal commodity of consumption is wheat. Wheat. There is no GST on wheat because wheat is an agricultural produce. But then when it comes to rice, which is the principal product of consumption in the southern part of India, the branded rice is charged at 5%. 5%. Now that is because of, let us say, basmati, and that triggered the branded rice GST. But then when I buy rice, which I want to eat in my house in the southern region, which is a branded rice, I pay 5% GST. But when I buy wheat, I don't pay any GST, because wheat is an agricultural produce. Rice is a produce of agriculture. That is the difference.
Correct.
Thank you so much.
Thank you very much. Thank you.
Yeah, thank you, sir. Indeed, it was a wonderful session, and the way in which you explained the nitty-gritties of cascading effect, Rajendra Kumarji, it was really wonderful. Yeah, now I think the concept of many of the participants would have been clear regarding the GST indirect tax part. As rightly pointed out by you, this is a dynamic tax, and which Arpit also acknowledged that we all are at our loggerheads because of the ever-changing laws and provisions related to GST, which has kept us busy throughout the year, and we assume that this will continue till we are in GST.
Eternity. Till eternity. On the 12th of this month, the
That's a
GST
better
Council meets. On the 12th of this month, the GST Council meets to consider the report of the group of ministers or so, where they are going to bring out with some more changes are in the offing. So, I very jocularly say, when you deal with consumption taxes, you never grow old. You are always young because you are kept on your toes always.
I remember that श्री 420 का एक जो राज कपूर और नरगिस पे फिल्माया गया गाना था, हम न रहे तुम न रहे बस रह जाएंगी तो सिर्फ जीएसटी और जीएसटी।
हम न रहेंगे तुम न रहेंगे फिर भी रहेंगी निशानियां।
So it was a wonderful session, and Professor G. Soralji rightly pointed out that you also have very dedicated team. When you said that a student of yours came 15 kilometers down the line to you for facilitating you to come on the screen, it shows the commitment on the part of your student, which in a way is a compliment to you also, that the such kind of dedication you have been able to create on your students. Friends, on behalf of WIRC, I indeed acknowledge gratitude to Rajendra Kumar ji, Chairman GST Indirect Tax Committee ICAI, and Professor G. Soralji, President IAA, for the wonderful program, wonderful arrangement what they have done. And we are indeed thanks a lot for making this program a great success. Thank you very much.
Thank you all for the opportunity. Thank you.
Thank you.
Thank you. So we are closing the session now.
So we are closing the session now. Yeah.
Oh, okay. Yeah. See you tomorrow. Thank you very much.
Yeah. Thank you.
Okay.